that really captures the market's attention here in Europe in the early days. Perhaps it is the latter of those in the opening moments of trade that we will be watching out for. So the FTSE 100 is open. The rest of Europe yet to get there. But the IBEX up by 0.5%, expecting then to see quite a firm rebound in stocks after yesterday's weakness as a result of those the President Trump lines, or the reporting around President Trump's lines, the things he said to Republicans about whether he should or should not fire the Fed chair. As a result of that, then, we see stocks here in Europe rebounding up by 0.7%, the FTSE 100 up by 0.5%. So, Lizzie, that seems to be the dominant theme this morning. It's all about that big picture Fed narrative, whether we have Fed independence. Mark raising an interesting question earlier on about whether this was always going to be stocks negative, the speculation around the Fed chair, because if the markets had taken a rate cut as a positive thing, then it could have been stock positive, but it wasn't seen that way by markets. Risk assets sold off and then rebounded on Trump's denial, and we need to price some of that in here in Europe.
Yeah, so when we look at the sectoral breakdown as things stand, tech, as you might expect, the best performer this morning, top of the basket up 1.4%, and this comes back to TSMC raising that 2025 sales outlook. As I say, a big boost for AI chip demand, and individually, some of the individual stocks that we're watching, I mentioned Novartis lifting its outlook on this quarterly profit, beating estimates. Shares up about 7% this year, but actually Novartis shares down 1.9% at the open. So not enough for traders, it seems, those results. Then we have to look at Volvo. So we've had results from both the cars side and the truck side. If we take cars, their income fell in the second quarter because of tariffs hitting sales. Volvo Car is actually up 6.3%, and Volvo Truck earnings beating estimates because of firmer European market demand. And Volvo Truck is up 2.9%. We've had results from ABB and Ocado, waiting for those to start trading. But at the moment, as things stand, Anna, as you say, on the Euro Stoxx 50, we're up 0.9%.
It looks as if ABB is halted, Swiss-Swedish, so listed in both places, and we'll wait to see some response there. It is an interesting story. I was taken by a few angles on this one. We had strength in the US, which I thought, given all of the volatility and the conversations around market uncertainty, meaning that businesses won't invest. I think it's interesting that this is a business that sells automation services and other industrial products, and if their clients have the appetite to invest, that's an interesting narrative around the US. And the fact they're exposed to data centers also tells us something about where that investment is coming from. Autos, on the other hand, is part of their business, and that's a negative. But we have seen some suggestions that this one will go higher at the start of trade, so we continue to watch that one, of course. But anyway, that's just one stock in a sea of many.
Yeah, and of course, as you say, the real dominant narrative really is about the Fed chair, Jerome Powell, and whether he's safe in his job. So let's discuss further. We have Koku Agbo-Blower, who is Global Head of Economics, Cross-Asset and Quant Research over at Societe Generale Corporate and Investment Banking, with us round the desk. Good morning.
Good morning.
I want to start with the Fed then, and whether the market's underpricing the risk that actually the president is going to fire the Fed chair.
Well, I think it is ultimately not a new news, because we've seen these remarks a few times. I think the market is clearly afraid of having a repeat of Arthur Burns, who was the Fed chair from 1970 to 1978 with President Richard Nixon, where he ultimately didn't raise interest rates because Richard Nixon at the time said, I didn't care about inflation, but wanted full employment, and that's essentially why we had this spike in inflation in the 70s and 80s. But I think the key theme is to remember that the Fed chair does not dictate policy by himself. It's a committee. So ultimately, he's one vote amongst many of the board members. So we have his term ending late 2026. So I think firing him wouldn't make sense given the timeline. There are already candidates to replace him, so I think the focus will be on them. But even if we have someone who's more dovish and willing to cut interest rates, we do not think that this will necessarily mean the end of the independence of the Fed.
Okay, that's interesting. And it's interesting that you mentioned the Burns example. A nice history lesson to start off the day.
Thank you, Coco.
Yeah, do you just kind of ignore if there's a kind of political appointment to the Fed chair? Because, as you say, you've got the rest of the FOMC there, and it doesn't really matter what the Fed chair is saying. How would the market react immediately and longer term if Trump fired Powell?
Well, it will react pretty badly because, as you know, at the end of the gold standard, and it was the Nixon shock, the dollar is not backed by gold anymore. So it's essentially based on the full faith and credit of the United States of America. So it also means that any sort of central bank biggest asset is its credibility. So if that were to go through a firing, the market will take it very badly. I think we would have pretty significant amount of volatility. But then it's an interesting situation because you would want to think about who will be the replacement, but that simply is going to increase volatility for asset prices and lack of confidence in the dollar, which has been one of the big themes this year.
So weaker dollar, more volatility, markets react negatively, then you say risk assets would react negatively. How concerned are you about long-end yields then, Coco? Tie that into because it's easy to think, well, maybe if there's going to be more inflation, if there's a different Fed chair, then there's more need to price that in at the longer end. But is there something about the institutional credibility of the United States and the reliability of the United States as a partner that gets priced in at the long end as well?
Yeah, I mean, this was one of the big themes of this year, the whole deglobalization or de-dollarization, the end of U.S. exceptionalism. But as you saw in the data, well, I mean, the S&P is back up to a record. It is underperforming Europe, that's up sort of 10 to 20%. But one of the things you have to realize is that the U.S. equity market is roughly $60 trillion. Nvidia is $4 trillion. The Eurostoxx 50, top 50 companies in Europe is $4 trillion, roughly the same size as Nvidia. And the total European market is 14 trillion. So the size of the US market is just enormous. And going to the bond market, we have the steepening yield curve across the board, gilt in particular. But this is, in my opinion, going back to normality in terms of the yield curve after decades of quantitative easing and distortion by central banks. I think it is also reflective of the sort of worsening budget deficits of the fiscal policy in the US, but it's also linked to this original sin that we saw after the pandemic in 2020, where government spent trillions to save human lives and corporates. So I don't think it is an issue in the short term. I think it just adds more risk premium. But a lot of investors are worried about another Liz Truss phenomenon in the US, but we don't believe in that scenario.
Okay, but do you feel confident enough in pricing in steepness, though? You think that the US long-term, the direction for long-term yields is higher because we lived in a world where rates were really, really low, then government spent a huge amount of money during the pandemic, and then at some point that's got to all be paid for?
Yes, that needs to be reflected. So investors need to be compensated for the additional debt. So we have roughly 30 to 36 trillion, depending on how you account it, for the U.S. Economy. And this needs to be reflected in higher risk premium. So you get better carry. And at some point, you could have the bond vigilante forcing governments to tighten.
That does sound like a Liz Truss moment, but you don't think that's coming?
That's probably going to be later. I think if we were to hit like the 6% type levels, then I guess this will create a bit more volatility. The last comment I also say is that there are changes on a regulatory standpoint, like the SLR, for example, that's been talked about quite a bit. That could potentially increase the buying capacity of U.S. banks, of treasuries, by alleviating the pressure on their balance sheet, so maybe $2 trillion of buying capacity. So that potentially could offset as well.
So that could mean that we don't necessarily see such a spike up in long-end yields like we did some months ago when banks found they couldn't buy enough long-term debt because of the restrictions on their balance sheet.
Yeah, so that could be that. But then there's also some discussion that it may benefit the shorter part of the curve than the long end because of the volatility we've seen. But yeah, let's watch this area for sure.
Can we just talk about tariffs? Can I bring back that word of Jamie Dimon's, complacency? Is the market too complacent about what trade deals are going to come around by August 1st, do you think, Koku?
Well, this is a brilliant question because as we all been going through an environment of heightened volatility, there's a derivative term that's called heteroskedasticity, which comes from Greek that says high volatility or volatility. So the key point is then if you have an environment of high volatility, then you can hedge and buy volatility and see what you expect. But periods of back and forth is what makes things very complicated for investors. So if you look at the sensitivity of markets to Trump comment, it has decreased because at some point, fool me once, shame on you, fool me twice, shame on me, and then you should fool me 10 times. At some point, you just stop playing. And I think it leads to this interesting phenomenon where when we talk to investors, maybe the best trade, the best position is to have no position, or at least the reduced position given the uncertainty. So our base case scenario is that this will be extended, but if it doesn't, then the market will react, and that will force maybe another tackle, as the term goes.
So you do still believe that somebody chickens out at the end?
Yes, absolutely.
Yeah.
Because the cost of having a full-blown trade war, and one thing to monitor is if this were to go into services, because 70% to 80% of GDP in the Western world is services, not goods. And Europe has mentioned potentially retaliatory measures in services. Think about tech, financials, etc. So I don't think we want to necessarily go there at this stage.
Okay, Koku, thank you so much. Thanks for your time. Koku Agbublua, a global head of economics, cross-asset and quant research at Societe Generale Corporate and Investment Banking. European equity markets then rebounding from yesterday's lows. A lot of this, of course, driven by the commentary from the White House about firing Jerome Pal and then not firing him. And we see the rebound due to the latter part of that statement this morning here in Europe. So Stock 600 up by 0.6%. How does that play out for the core six? We see quite a lot of divergence here. Schneider Electric really strong, up by 5.9%. Some of the other names there, Ferrari also up by more than 1%. Novo Nordisk on the back foot, down by 0.9%. Let's check in on some of the individual stocks, though, that are on the move this morning. Chloe Melly joins us. Good morning, Chloe.
Good morning, Anna. Let's start with some good news over from ABB this morning. It reported a really strong uptick in order growth for its automation tools for factories, especially from the US. And the CEO said that it expects this year to be a record year for ABB. And that is pushing the stock up almost 8% this morning. Quite a significant move. Moving on to ASML. ASML is also up this morning. It had quite a tough day yesterday, but today it's off the back of TSMC upgrading its projections for 2025 sales, and that is pushing up ASML up 2.3% this morning. So rebounding after a tough day yesterday. Moving on to another aspect of this AI story, data center equipment. So Legrand raised its 4-year sales target. Legrand makes infrastructure cooling equipment for data centers, and it's really benefiting from this AI boom. And Schneider is also being brought up as well alongside it as one of its key peers. And then finally, another good positive move from, it was positive at the open. Novartis is actually down now, but Novartis raised its guidance for the year on the back of really strong sales for its cancer drugs, and it also said that it was going to have a new buyback and launching a new buyback. But it seems that was not enough for investors, and it is down 2.2% this morning.
Chloe, thank you very much. Chloe Melly from our equities team with a rundown of some of the stocks in focus. We've got some numbers out of Ocado this morning. Ocado maintaining its full-year technology solutions revenue forecast. They still see, they're sticking to their forecast, but we've got a price for them this morning. They go up by 10%, so that's the reason to mention it, the fact that they are up so substantially this morning on grocery retail.
Yeah, pretty good, because, of course, they've got to deal with that rise in the minimum wage. That was thought to be a hit to Ocado, but a stonky performance, best on the Stock 600 this morning. But coming up on the programme, we'll get to more earnings out this morning. Volvo Cars' second quarter revenue beating estimates. So we'll bring you more on the company's earnings results and cost-cutting strategy next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bercecci in Vienna, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are well on track with the indirect cost savings. Then we also work to save around 3 billion on the direct cost side. And then we have a very good cooperation right now on the really part number level with Geely, where we are looking into to see how to bring down that. And then the big chain is then with cash and working capital measures, which is showing very good result.
Hakan Samuelsson, CEO of Volvo Cars there, speaking to us a bit earlier. And that interview came after Volvo Cars reported second quarter revenue that beat the average analyst estimate. So for more, let's bring in Bloomberg's Global Autos editor, Craig Trudell. Craig, it seems like they've been hit by tariffs, these sales from Volvo Car, and a plea we had from the CEO there as well when it comes to tariffs, speaking to the EU.
Yeah, I think Mr. Samuelsson has a sort of message for Brussels that essentially, puts a little bit of the blame on them for the fact that there's so much tension between the EU and the U.S. from an automotive trade perspective. He has a point here in terms of the charge that the EU was putting on imports of vehicles from the U.S. That being said, this is now a case where it's gone from a little bit lopsided in the EU's favor to lopsided in the U.S. favor, and there's of course some sort of fine print here that there's not a whole lot of issues with trade from a tariff perspective. This is more so a problem of a mismatch between the types of vehicles that are bought in the EU versus what the U.S. is making and selling.
Yes, Craig, good morning. So do we have the sense that a lot of European car makers might share this view, telling the Commission, look, let's just cut tariffs on US imports of cars into Europe, because European customers often drive on roads that are too small for them anyway, need to park in spaces that are too small for them, so not many of them will get sold anyway, even if they are tariff-free. Would that be a line of argument that lots of car makers would agree with?
I think they would prefer to see, both sides, disarm, right, and take tariffs down. I think the likelihood of that happening, given the sort of approach of the Trump administration and the views of the president, when he talks about trade, cars are sort of, an industry that is at the tip of his tongue. It's a way for him to sort of hammer the rest of the world in the sense that there aren't a lot of major countries where the U.S. has a trade surplus, right? And so this is a sort of industry that is consistent with his worldview that the U.S. is being treated unfairly. And I it does not feel like there's a particularly high likelihood that the U.S. is going to, go closer to zero after all these years of the U.S. not being on equal ground with these other countries, or being in a position where there are so many cars coming into the U.S. From other markets. There seems to be a sort of bias toward let's go higher as opposed to let's bring each other's tariffs down.
Yeah, so that could be the thinking that gets in the way of that tariff disarmament that you described. Craig, thank you very much. Bloomberg's Global Autos editor, Craig Trudell. Let's pivot on to other earnings stories we've had out this morning, from Volvo Cars, which is up by 8.7%, to ABB, where shares are surging this morning after posting a second quarter beat and reporting strong order growth. The CEO was on Bloomberg earlier this morning and talked about how tariffs are impacting his decision-making.
That clarity on what will have an impact, where the tariffs are going to end, especially between Europe and the United States, but also inside North America. I think those are where we see trends where kind of decisions are not canceled, but they are delayed. They are postponed, just in the wait there to see. But so it probably will take a quarter or two, but it's very hard to predict when the trade deal is struck these days.
So this is a business, Lizzie, that is, on the one hand, yes, it supplies the auto sector, and that's not going to be a great place to be right now, but it also supplies data centers, it supplies automation and factories of all kinds, robotics, process automation, power products, all of these products, when you're in a world of electrification and moving towards more electricity use rather than other forms, in high demand, it would seem.
Yeah, so good news that for ABB. I also just want to take a look at EasyJet. We just put the price on the screen there, down 6.9% as things stand. It's the second worst performer on the stock 600, and this also comes back to earnings, but the theme is different. It's not a tariff story here. Their profit growth has been hit by fuel costs and strikes, those French ATC strikes, and the CEO, Kenton Jarvis, says he's extremely unhappy with those French strikes because of the unexpected and significant costs for carriers that they created. So EasyJet shares really suffering this morning off the back of those results.
Yeah, absolutely. I mean, getting a sense of the cost and the disruption that kind of strike activity brings for these businesses is, I mean, it's something that sometimes has an impact on shares, sometimes doesn't, but it is a sort of perennial risk for companies that operate in Europe that you're going to have to face these kind of delays. Let's pivot to another sector where we've also had numbers out this morning. Turning now to the healthcare sector, Novartis shares have been on the move this morning, now down, as we were hearing from Chloe earlier, despite the Swiss pharmaceutical company raising its profit outlook after reporting better than expected results for the latest quarter. Sometimes that isn't enough. Bloomberg's Europe healthcare reporter Tim Lowe is with us. Shares are down then, Tim, despite the fact that the earnings, there seems to be some positivity in there. What is keeping investors wary?
Yeah, there's kind of two factors that are a little bit disappointing this morning for investors. The first is the CFO, longtime Harry Kirsch, announcing he's going to be stepping down next March. He's really considered a rock star in the sector. One analyst note this morning referred to him as widely regarded as the best CFO in the whole industry. So, I mean, he's been CFO for 12 years, so he's kind of earned his retirement. So that is, I think, perhaps disappointing investors a little bit. But the main thing they're also zeroing in on is one of Novartis's top growth drugs, a psoriasis medicine, came in disappointed in the quarter, and that was driven by a little bit of weakness in the U.S., but also primarily in China. So those are sort of the bearish signals this morning.
But is it all doom and gloom at Novartis this morning, Tim?
Definitely not. As you mentioned, they raised their profit outlook for the year just a tad. It wasn't a massive raise, but there are 2 new cancer drugs that they're also going to be relying on overperformed in the quarter, so that's good news. I would say, generally speaking, much of their statement came in more or less in alignment with expectations. So I suspect a lot of the focus is going to shift later in the day to the analyst call with the CEO. He's already in the U.S., and they're going to be talking about, tariffs in the U.S. and U.S. drug pricing and how that's all going to evolve.
Yes, is that going to be the focus for investors then as the day develops? Because drug pricing in the United States, I think I've been asking big global CEOs about that subject for about 20 years, Tim. Are we going to get some real news lines on that, do you think, under President Trump?
There's certainly a lot of news. The question is when it sticks and when it really, comes into effect, which is creating all this uncertainty. So there's going to be a lot of people training in to listen to Novartis' CEO today as he talks about it. Again, Novartis is the first big European pharma company to put out earnings this cycle. So a lot of focus on what gets said later today.
All right, Bloomberg's Europe healthcare reporter Tim Lowe, we thank you for that update on Novartis. As we look at those shares down 1.6%, a much bigger mover, though, I will take you to is Wise out of London, down nearly 8% this morning off the back of their results. Underlying income missing estimates, this of course the London-based fintech. So those shares really suffering off the back of those results.
I'm all about data centres and engineering, it seems, this morning, because Legrand over in France, Chloe put this one on our radar, didn't she? Legrand, there we go. Yes, they design and manufacture electrical devices, but crucially one of their customer bases is data centres, and there again we see some positivity. So just like ABB, that's playing out well for them, and that seems to be lifting the likes of Schneider Electric. So the CAC 40 is actually up by 1%, the DAX up by 1%. So a solid rebound, perhaps on some of these earnings stories, but also, of course, big picture on the rebound from the White House Fed-induced sell-off of yesterday that we then had to catch up with this morning here in Europe. Coming up on the programme, finance ministers from the world's biggest economies are meeting in South Africa. We will discuss what is on the agenda with Maria Vaselu, head of the Pictet Research Institute, next. High-level delegation from the United States is missing at that G20 meeting. How do we weave that into our expectations for emerging and developing markets going forward? This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
This is the opening trade. We're 30 minutes into today's session. You can see it's green across the screen for European stocks. But we want to go to South Africa now because the world's most powerful finance ministers and central bank governors are gathering there for the G20 meeting. Attention, of course, is firmly focused on limiting the fallout of the global trade war. But South Africa's central bank governor has expressed confidence that the G20 can reach, this time, a communique.
It would be great if we have a communique, but if we do not have a communique, it's not a trade smash because the conversations continue.
Let's speak to Jennifer Zabasajja, who's on the ground for us. And Jen, what's the sentiment there? What are you hearing about the current trade tensions? Tariffs, of course, dominating the conversation. Well, we'll get to Jen in just a moment.
We don't have an answer to that just now, do we? It was interesting. I was reading a lot of our coverage about the G20, and clearly the fact that the United States is not there with a high-level delegation is going to be
absent.
Right, absolutely. So that's going to be something of a focus because not having, one of the big architects of the global economy there and present might limit the ability to deal with a lot of the issues that the G20 wants to deal with. And of course, the US providing a distraction in the shape of tariffs from the things that the G20 wants to talk about. Things they did want to get on to discussing, I understand, debt forgiveness, climate change, all of these sort of perennial themes for a gathering like the G20. But yeah, without the US, you wonder what kind of progress can be made.
Yeah, well, let's actually analyse this first because we'll wait to get to Jennifer Zabasajja. But in the meantime, we're joined round the table by Maria Vaselu, who is head of Pictet Investment Institute over at Pictet. And you've been writing about this, Maria. Good morning to you.
Good morning.
As Anna mentioned, you've got the US Treasury Secretary, Scott Bessent, absent from the G20. I wonder what that means for the nations and what it says about the US as a reliable trading partner. Is it reliable?
Well, we are going through a period where we basically have U.S. against the rest of the world, and U.S. is trying to change the terms of trade, the way the nations collaborate, and so it's no surprise that at the time of intense negotiations around trade deals with the rest of the world, the U.S. would not want to be part of this gathering. Also, what we're seeing is the emergence of a bipolar world, where in one side you have U.S. and the G7, and on the other side you have China with the BRICS. And so the importance of G20 is a little bit diminished, I would say, at this point.
Well, yeah, on China, we've got reporting saying that actually behind the scenes, Trump seems to be softening his stance when it comes to China. Is that what you're seeing? And how does it change your expectations of where that trading relationship ends up? Because, you've seen Trump conceding ground on chips, for example. Does it say to you that actually he's more concerned with getting deals over the line than he previously seemed to be about national security?
At the end, I think both President Trump and President Xi are rational leaders, and so they would want to have a positive sum game deal. And China has a short-term problem because it needs the U.S. markets to promote its products and maintain its growth rates. But if it manages to do well in the short term, it has a great trajectory. U.S. has a better short-term outlook, but it has a problematic long-term outlook if it doesn't manage to maintain its leadership in technology, manage its debt overhang, and so on. So there is room for collaboration between the two, and I think that's really what you're observing.
Away from the relationship, that bilateral relationship, thinking about the role that the US is playing in global trade right now, Maria, when we've heard from the White House on their stance on global trade, some people say, well, that's global trade is now off the table. It's a different world we now live in, much more bipolar or multipolar, for example. Is it possible that we end up in a situation where the rest of the world trades more with other parts of the world? It's just the US that takes it out of the equation, or is the US setting the direction of travel for all?
We have already observed that the trade, for instance, within BRICS Plus has increased about 200% in the recent years, and that's at the back of the sanctions that the US and EU have imposed on Russia. Certainly, there is a sense in the rest of the world, and particularly among BRICS and among Asian nations, that they need to find ways to hedge against their dependence on the US. So some level of disentanglement will happen. I don't think that there will be no trade between the US and the rest of the world, but in a way, we can also make the counter-argument that trade had gone too far, and it had created a lot of unintended consequences.
Yes, and so other developed nations, do they actually fundamentally come on board to the US view that trade and globalization went too far, the benefits were exported, and the negatives stayed at home?
We have two examples that really support this argument. One was the Great Recession of 2008, where we saw that countries that were too specialized had a hard time recovering from the crisis. And the second example was COVID, where whole economies got paralyzed, even for production of domestic products, because they were so much dependent in their supply chains from other nations. So, and also, if you look at the U.S., manufacturing represents only 19% of the economy. That's a very low number compared to the rest of the world. For example, in China, 45% of the economy is manufacturing. So certainly the U.S. will not go up to that level, but there is room to increase. And at the end of the day, what nations should be focused on is increasing their economic resiliency. And that has really suffered under globalization.
Maria, of course, a consequence of this US trade policy has been dollar hegemony weakening. Do you see a viable alternative out there in the other nations that you're looking at? And on what time frame could that happen?
The reality is that there is no viable alternative to the US dollar at this point. And even countries like China may not want to create an alternative, because that comes also with a lot of responsibility. They may not want to extend their external debt to the level that the US has done. They may not want to open their economy to the level that the US has done. So I don't really see a credible alternative. People talk about the euro, but the European Union would have to do a lot of reforms, deepen its capital markets, its debt markets, create common issuance and so on, which are not on the pipeline at the moment. And so I don't really see a credible alternative. What we are seeing is a really very focused effort to bypass dollar settlement systems. And so that is happening, but that does not amount to de-dollarization.
And is that limited to BRICS, or is that other nations trying to limit use of the dollar in those ways?
Certainly, BRICS are leading the way in that respect, and they have done it very effectively. And as a result, Russia has managed to evade all the sanctions that the U.S. and the European Union have imposed on it. And that's why the Russian economy continues to grow, despite all the predictions that it will go into a deep recession.
Much to the chagrin of President Trump, I might add. Maria, really good to see you. Thanks for joining us around the table this morning. Maria Vaselu, head of Pictet Research Institute over at Pictet Group. And it's a fascinating conversation to set us up for our report from Jennifer Zabasajja. She is, as I say, on the ground for us at the G20 meeting over in South Africa, and we can go to her now. Jen, what is the sentiment on the ground there about the current trade tensions, which seem to be dominating discussions, even if they'd like to focus on other things over there?
Right, Lizzie, I mean, if you ask the South African government, they would ideally like to focus on what they came into this presidency focused on, which is the theme equality, solidarity, and sustainability. But yes, I think that's sort of the overhang that many people are talking about. Even in our conversations that we had yesterday, we spoke with Governor Khanyaho from South Africa and also Jan Stoltenberg, and they both talked about tariffs and the tensions that do exist between a number of these G20 member countries. And yet, you know, if you're asking about the sentiment, Khanyaho actually reflected that there actually seems to be some positivity that they're actually able to have these conversations. Now, the question is whether or not they're going to be able to find an agreement in terms of finding a communique or getting to a communique by the end of this. And of course, we should note the U.S. Treasury Secretary Scott Bessent is, of course, not here. The U.S. delegation, though, did send a representative here. And so we are seeing the G20 central bankers and finance ministers meeting right now. They're talking about a number of topics and considering the confluence of issues that they're facing both domestically but also globally. It'll be interesting to see whether or not they get anywhere closer to achieving some of the consensus that they're hoping for ahead of the Leader Summit in November.
Yes, and with the US not there, Jen, and the trade conversation very much a distraction and front of mind for many who are there at the G20, does that limit our expectations from the G20 meetings over the next couple of days? What are we expecting to see?
You know, Anna, we did pose that question to a number of the officials that we have spoken with, and they do still believe that there is U.S. engagement. Not Scott Bessent, of course, as we just mentioned there, but there is still U.S. officials who are here on the ground, and there are still a number of issues that all of these G20 members have wanted to bring up and at least discuss. But really the question is, where do the priorities lie in terms of a number of these countries? At least as far as South Africa goes in terms of its G20 presidency, it was prioritizing a number of issues for the Global South, MDB reforms, also debt sustainability and climate finance. And the question is whether or not they're going to be able to get some of the bigger G20 members on board with that. Later today, we are going to see UK Chancellor Rachel Reeves is going to be here. She has a number of meetings with investors and companies as well. And so potentially, it's not going to be dominating all of the discussions that are had here. They're also planning to talk about things like productivity and AI, also cross-border payments, which of course is dominant in the Global South. And so, you know, we'll see whether or not they can find some consensus. But I think, as Governor Khanyaho said to me, there's a lot of uncertainty, so it's really hard to nail any sort of decision-making right now. So we're going to watch out for what they actually come up with over the next 2 days.
Jennifer, thank you very much. Jennifer Zabasajja, our Chief Africa Correspondent, thank you very much for joining us. Lizzie, we need to pivot to a conversation about the banking sector.
We do indeed, because we've had lots of Wall Street banks reporting record revenue hauls as they reap the benefits from all of the volatility around tariffs. The details are coming up next. This is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
They've got money in their accounts, they're employed, and the wage growth has been relatively strong, and you know, so they're in pretty good shape. The credit quality is good. They have equity in their homes. They're low rate financing the mortgage, so consumers pretty good. When you go to small businesses, that's more the question. Small, medium-sized businesses.
Bank of America's CEO Brian Moynihan telling a pretty positive story there about certainly the U.S. consumer right now. Staying with the U.S. and the U.S. bank earnings season, and Goldman Sachs stock traders have posted the largest quarterly revenue haul in Wall Street history, raking in just make sure I read that right, $4.3 billion of volatility sparked by the Trump administration's trade war. Across the top 5 U.S. banks, first half trading revenues surged by $10 billion year over year. Joining us now is Bloomberg's Jenny Surain, who has been entirely focused on the U.S. bank earnings story, and all of the traders are delivering. Jenny, good morning to you. So which of the trading desks, what are the trading stories that are really delivering here for Wall Street?
So definitely the stock traders. I think, as you mentioned with Goldman Sachs, that was pretty indicative across the board. We saw really big gains from all of the major banks in the U.S. On the fixed income side, we saw a really high level of activity on rates desks, on the currencies desks. So, of course, all these things that would be, most directly impacted by the tariffs and kind of the U.S. trade policy discussions. So really broad-based gains for these banks. It was a really stellar quarter for them.
And so volatility has been good for trading, but bad for deal making. We were debating earlier, Jenny, with Mark Goodmore, whether actually the next half of the year could see boardrooms getting used to the volatility and actually deal making picking up, because we were meant to see
loads dubious of this view, wasn't he? But it was a nice question to ask.
So I'm optimistic, but look, because deal making was meant to kick off under Trump, and it's the opposite.
Yeah, no, we actually heard a lot about that this week, and I think what we heard from these CEOs was all these clients are still really hyper-focused on the uncertainty and the tariffs and kind of where those net out. As soon as they get that certainty, the CEOs really were confident that we will see that pickup in deal making. But I think that's a matter of when and kind of how soon they get that certainty.
When do I get to put certainty in my diary? I don't know. When is that day? I'll find a calendar to put it in. So what is the outlook for trading from here? Because it's one thing to report backward-looking numbers that have been driven by volatility and you've benefited, and fine, that's been good. But what does that tell us about their ability to keep delivering on that?
Yeah, trading is a tricky one because it's not like past performance indicates future performance. So it'll be interesting to see. Volatility is really difficult actually for these trading desks. They have had so far kind of that Goldilocks moment for volatility. So it was just enough to get clients active and engaged. They wanted to be playing these markets, but sometimes it can be too much, and then they get scared and they sit on the sidelines and kind of wait it out. So if this volatility persists, do these clients kind of get that fatigue and start sitting it out, and then you see that revenue come down? It'll be sort of, it's hard to know in advance, but it'll definitely be something we're keeping a close eye on.
Well, with past performance in focus, who's been the biggest winner? Is it obvious?
I think Goldman was the big winner this quarter. I mean, the stock trading numbers you guys talked about earlier, obviously really strong. Their deal-making numbers actually came in really strong. So they finally retook that #1 crown in deal-making back from JP Morgan. It was a big loss for them when they lost it. So I think Goldman had, it was kind of firing on all cylinders, as it were. The other big one this quarter was Wells Fargo. They have a little bit of a smaller trading and investment banking business, but they lost their Fed asset cap just a couple weeks ago, and they had lots of good things to say about, plowing into new businesses and kind of taking advantage of this moment.
All right, well, those bank earnings really helping to fuel the rally that we saw yesterday on Wall Street. But it wasn't, Jenny Serene, we thank you so much. But of course, it wasn't just about the banking earnings story. It was also about the relief on the central banking story. Donald Trump saying that he did ask Republican members of Congress whether he should fire the Fed chair, Jerome Pal, but then saying that he has no plans to get rid of him, despite his recent criticisms.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad.
So we have a stupid person, frankly, at the Fed. I call him Too Late Pal, because he's always too late.
I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job.
Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
And after all of that, it seems Powell is safe for now. Or is he? Let's bring in Bloomberg's Valerie Teitel. Val, the president saying that the Fed chair is safe for now, with this massive caveat, can the market forget about it?
I don't think so. I think they're going to have this on their mind up until we actually hear the Fed appointee, whenever that comes sometime next year. It is normal course of action that the Trump administration should pick the Fed chair just a few months prior to May, which is when Jerome Powell steps down. So we have to wait until then to get some sort of clarity. But I think the markets will have to deal with the risk that we could get an escalation further from the White House, between the White House and the Federal Reserve. I think yesterday was a real eye-opening on just how the markets would take it. I mean, it was really pretty incredible, the hour of trading where we did see this Sell America theme come back, where all U.S. assets traded lower, whether it was the U.S. dollar, the back end of the Treasury market, or equities going lower. It was funny to see, even in that 90 minutes of chaos, that we actually priced in one additional rate cut until the end of the year just on this chaos. Now, a lot of that was unwound, but I think that gave us a glimpse of the price action we could see if this was ignited further.
Yeah, I mean, and of course the market's focus is on what this means for policy making, what it means for the Fed independence, all those big questions. But just on a personal level, I mean, what an incredible amount of pressure to be under as one person, to have your boss, or the person who employed you in the first place, using that kind of language that we just replayed there to describe your performance. Quite incredible, really. But back to the markets and what we saw there, Valerie. I mean, is there any sense? So Mark Cudmore was talking earlier on about what we've lost already on Fed credibility as a result of all of these conversations and all of that rhetoric we've heard from the White House. Is there anywhere to watch that develop and play out in the market? I was wondering about the short end, the way we see it move on President Trump's comments around Jerome Powell. Does that tell us something about how much the market thinks the White House is in charge here, not the Federal Reserve?
Well, going forward, it'll be very interesting to see if we start getting dissents in these decisions. It's something that Powell has not really had to deal with a lot during his time as Fed chair, but we've heard hints already. There's been 2 people who voiced support for a cut in July. Whether that comes into an actual dissent to the decision will be very interesting. But that's the kind of political pressure, Anna, that could show up sooner rather than later. Maybe not Chair Powell changing his mind, but others on the board not wanting to invite this kind of criticism and maybe wanting to throw into their hat into the ring for that Fed chair job, and dissenting at one of these decisions would be, a way for them to do that. And that's already kind of how you can understand how this political pressure is already making way through the Fed. But remember, come next year, it is really not just the Fed chair that Trump has a pick on. There's also Adriana Kugler, who's stepping down in January. That's another Fed pick. And then if Powell also vacates his Fed governorship, which is a normal course of action for a chairman stepping down. That would be 3 seats on the board for Trump to choose. Remember, the board of governors is only 7 seats, so that's what 3 out of 7 seats are available for Trump.
Yeah, a lot of shaping then that he could do of the Fed. Lizzie and Val, let's have a moment on the UK. We had the UK data out this morning. Firms cutting jobs, wage growth slowing in a cooling labour market. This on the day, you know, that this is the bit of stagflation, and yesterday we got the flation bit of stagflation with that CPI print coming in 0.2% higher than had been anticipated. I mean, what does this do to our expectations around the Bank of England?
Well, actually, you can see that traders have slightly pulled back their bets on BOE rate cuts off the back of this. You've got gilt yields higher across the curve. I also just think it's a bit of a nightmare for Rachel Reeves, right? That to have unemployment at its highest rate in 4 years.
Yeah, if we can trust the data, of course. You know, in particular, the percentage, that unemployment percentage, I think that's the one that markets have steered away from for a while.
Yeah, no one wants to pick up the phone for the labour force survey. But, you know, the Chancellor being blamed by companies for raising the minimum wage and raising taxes. So, I mean, it's a nightmare for both the BOE and the Chancellor.
Yeah, and I know what you just mentioned about whether we can trust the data, because that's also not just a concern in the UK, it's also a concern in the US, that nearly 30% of the CPI basket was an estimate for that Wednesday's print. So it's really not just, I guess, the credibility of the UK's data, but a lot of data being pulled into question. And, you know, a lot of central bank decisions hinge off the back of this data.
Okay, thank you, Valerie. Valerie Seisel with us on a few of the market themes we're dealing with this morning. No doubt the relationship between the Fed and the White House will persist as a market theme. Let's go to some of the stocks that are gaining this morning then, and we've got on this board for you ABB, Legrand, Schneider Electric, Ocado. The first three are all united by sort of data center themes, a little bit different other themes in regards to ABB, but there is some of that permeating through there, and we've had earnings from Legrand and from ABB. Schneider Electric up in sympathy, it would seem. And Ocado, we heard some numbers from them as well, Lizzie. You've got, on the negative side,
I don't know how I wound up.
I know. Why did we end with this?
We've got EasyJet down. Their profit growth hit by fuel costs. Wise down, underlying income missing estimates, and Novartis down, even though it lifted its outlook on those quarterly profit beating estimates.
Okay, private markets in focus next. Per Franson, the CEO of EQT, will be speaking to Francine Lacroix next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Well, President Trump says he's not planning to fire Jay Powell after speculation about the Fed chair's future sent jitters through financial markets. President Trump eyes a tariff rate of up to 15% for more than 150 smaller trading partners, while also softening his tone on China. Plus, the world's biggest contract chip maker, TSMC, raises its outlook in a big boost for global AI spending hopes. Now, let's straight look at the markets. Happy Thursday, everyone. It's been quite a week, and it's not done yet. Now, the dollar adding some 0.3% overall. Now, this is really underpinning what we saw this week, which is fading expectations for U.S. interest rate cuts in 2025. But at the same time, we saw really some of the technology stocks in terms of futures advancing after Taiwan semiconductor manufacturing raised its revenue growth, therefore reinforcing some of the investor confidence in the sector and global spending on AI. S&P futures practically unchanged. The U.S. 10-year yield, look, it was, there were quite a lot of movements where there was speculation that Donald Trump was about to fire Jay Powell. That then was walked back, euro dollar 115.91. But it's really what's happening both in terms of technology, Fed expectations, and Jay Powell. That's also changing the mood in European markets. So let's have a look at that if we get to it, see what the CAC 40 and the FTSE are doing. You can see the CAC 40 gains some 1%. There is a little bit of a mood shift because of technology stocks. After yesterday, there were worries about ASML. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. president has denied that he's planning to fire Fed Chair Jay Powell, but says he did ask a group of Republican lawmakers whether he should. Now, leaks from the closed-door meeting at the White House suggesting that he had drafted a letter to remove Powell briefly sent markets into a nosedive.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
Jay Powell, of course, was nominated by Donald Trump in 2017. Now, joining us now is Bloomberg's EMEA News Director Ross Matheson and Emmanuel Ko, Head of European Equity Strategy at Berkeley. So thank you both for being with us this morning. Ross, I mean, he appointed him himself. And this is, I don't know, it's not even a philosophical kind of, concern on, longer-term rates. It's just that Donald Trump wants a cut now, and Jay Powell is not delivering.
That's right. And he did say, he came out in the end yesterday and said, I'm not planning to fire him, or rather try to fire him, because there's all kinds of legal questions about whether he actually could. But he even put some caveats around that. I'm not currently planning to do this unless ... there's something around fraud. And this is this issue again around these planned renovations to the Fed buildings, which the White House say are a waste of money and far over the top, and questioning all the arrangements around that. And he's going to keep pushing on that. They see that as a bruise to keep pressing on. And whether they want to get traction on that and at some point allege there's been some kind of misbehavior here over money, of course, that's something that Powell has strongly refuted. But you can see that whatever is the case here, whether Powell goes all the way through to the middle of next year, and then in theory could continue at least as a Fed governor, but the pressure's not going to ease up. I mean, Donald Trump's talking almost daily about Powell and rates and the Fed, and heavily critical of the Fed and where rates are. That's not going to dissipate even if Powell sticks around.
But so, Rosa, I mean, the tactic, I guess, is to wear him down so that he resigns. I imagine this is what the Trump administration's, favorite outcome would be. But it also feels like a warning sign for whoever comes next.
Well, that's right. And the reason you saw markets moving so much yesterday is not necessarily because everyone agrees with what the Fed is doing on policy. It's just the question again of is the Fed at some point going to become more responsive, you would say, or even beholden to what the White House is looking at when it comes to monetary policy, and that a replacement, the future Fed chief after Powell, whoever that is, and there's talk about Kevin Hassett and Scott Bessent, very much in the vein of echoing Donald Trump on policy. And do you have an erosion again of the independence of the Fed? And that's really the concern that you're seeing in markets.
Emmanuel, so I saw Jay Powell actually in Sintra at the ECB forum, and I'd never noticed that he had bodyguards before. And actually, there were bodyguards that were very attentive this time. You have a lot of, pressure coming, frankly, from all of the president's men, and the market is just worried about. What is it worried about? Is it central bank independence, or is it actually just testing what the president's power is?
Look, I think there's a game of chicken between Trump and the market to some extent. So markets are resilient, but this resilience is being tested by Trump on tariff. And we had the news over the weekend that we may have 30% tariff on Europe, and then the never-ending saga on the Fed, right? And I think maybe as long as the markets are so resilient, Trump will try to do what he said he would be doing. Right? So he said he would be hiking tariff. He's done that. He said he would have this massive fiscal stimulus. He's done that. And he said he would fire Powell. And obviously now this is what market is worried about, right? Yesterday gave us a taste of what would happen if that were to be the case.
But why is the market so resilient? So what is the market looking at? I know there's, TCMC is doing great results. But actually, do they think that, Trump won't follow through on tariffs and that he won't follow through on firing Powell?
Look, there is this taco, so trade always chicken out, dynamics playing out where, the feeling is that Trump ultimately will do whatever is good for the market. So there is a limit to what he can do, how much disruption he can bring to the market. And then, so far, growth is resilient. Earnings are resilient. And we are just starting the Q2 reporting season, early days. But what we are hearing from JP Morgan, from Goldman Sachs, from most of U.S. investment banks is that U.S. economy is holding up. We have a very good number from TSMC this morning. So despite all this uncertainty, you have corporate resilience, I think, acting as a backstop to the equity markets.
But, Ross, we don't actually know how Donald Trump measures success, right? There's a belief in the markets that he deeply cares about the markets. But it hasn't really, apart from a couple of wobbles in bond markets where he definitely stepped away, we don't really have evidence of that, do we?
Well, he says he doesn't really worry about the markets, but he's always watching them and responding to what the markets are doing. And he's on his own bat talking up the markets all the time, saying this is a terrific time to invest. So he's clearly watching the markets very closely. And, Emmanuel was just saying, the markets are resilient. So Trump takes that as a win. And he's going to keep pushing and testing the resilience of markets on that front, all those things he's done so far. And yet, the predictions of markets cratering haven't come true. He is dialing back a bit on trade again. We've seen even just overnight this idea now of 10 to 15% for a lot of countries. That's actually not far off the 10% baseline we're operating at now. And for a lot of countries, that's not terrific, but it's not terrible either. It's far away from 40, 50, 60% that he's been talking about. So you can see maybe countries saying, hang on, if we just sit tight through all of this, we don't have to negotiate heavily because we'll just end up with 10% either way.
Emmanuel, what happens in your world? Earnings, again, are holding okay. The economy in the U.S., you're right, is holding okay. Is it because everything has been front-loaded in terms of tariffs and the pain will come later, or can the economy just sustain it?
I mean, there's a possibility that, the worst is yet to come, that, the tariff impact will have some impact, some drag on growth and maybe some impact on inflation down the road as well. And there's a lot of anxiety about that. A lot of clients we speak to are not taking for granted the resilience we are seeing in the economy and in the corporate world because they are worried about things to deteriorate in the second half of the year. Look, our own economists are looking for a bit of a soft patch into H2, but without a recession being triggered, we are seeing there's enough strength in the corporate sector, in the consumer sector to avoid a recession. And to some extent, by the end of the year, the fiscal impulse coming from the big, beautiful bill should start to offset this or mitigate some of the drag on tariff. We have, ECB cutting rate. We have Germany stimulating. So net-net is going to be quite tricky to get to the end of the year without too much damage, but we're seeing the big picture is still a bit of an expansion of this cycle that we've been going on for the last 5 years.
But Emmanuel, how difficult is it? So we have actually a tariff tracker on Bloomberg, which is one of my favorite things to look at on the Bloomberg website. But it's difficult if you look at earnings, depending on the sector, because the tariffs change so quickly, to have a longer-term view of what some of the earnings or one of the sectors will deliver.
Look, I think the tariff will be a one-off. They will hit when they start, so we'll see a drag on growth and earnings, obviously. But I think at some point there will be other factors playing out. What we are seeing right now within the equity market is extreme polarization. So positioning is still towards the sectors, the stock which are somewhat immune to tariff. So in services, financials, things like telecom, utilities doing extremely well this year in Europe. And on the other hand, sectors exposed to trade, to dollar, to tariff have been doing very, very badly. So within the market, there's already a lot of positioning which has been driven by these tariff expectations. What could be a risk is that if you see a broader impact on the economy, that start to challenge this resilience. But I think so far, people have been rightly reducing risk, and that's why there's a bit of cushion going on that helps investors to navigate this uncertainty.
Russell, on the political front, how do we think Europe reacts to tariffs if they're deemed too high? It's also quite exciting to have the Chancellor of Germany here in the UK meeting with Keir Starmer.
Well, that's right. So it's interesting because the EU-US talks are still going on. We haven't had a lot of public commentary in the last few days, but we know that those negotiations are continuing behind the scenes, but they're very tricky because, again, Europe is saying, we thought we were negotiating. Suddenly we got a letter saying, this is your base rate, and that's it. And because this is a particularly tricky one with non-tariff barriers included, a whole lot of other stuff involved, Europe is standing its ground a bit with the US on it. And for companies, obviously, they are heavily saying to Brussels, can we just get some kind of understanding and avoid this escalating? We don't want a protracted trade war occurring. Auto very exposed in this region, pharma very exposed in this region, and a bunch of other sectors as well. But Europe is kind of standing its ground, and that's why this negotiation is dragging on and on.
Given all of this, and given what you said about expecting corporate resilience, but probably some dispersion or diversion, how do you concretely play the markets?
Look, we are still long equities. Summer is always tricky. People are going on holidays. We all need a break, I think, after a very busy first half, hopefully. But I think there is a lot of anxiety about how summer is going to play out. You got the bond market on edge. You got tariff. You got, obviously, the issue around budget and the Fed independence. So look, we have a bit of barbell allocation, but we are still long risk. The view is, look, we have the direction of travel is still good enough for us to stay with equities, with, again, earnings and growth staying positive. Within the market, we have a bit of a bias towards the domestics, but we've been starting to add back to the dollar exposure, which is very contrarian. But our view is that probably the bulk of the dollar weakness is done for now. And we're going to see at some point some clarity on tariff, hopefully sooner than later. But we think we start to see some emerging opportunities, bottom fishing opportunities in some of these cyclical laggards or exporter laggards. So we are long financials, long telecom, long defense. This is now extremely consensus. We start to bottom fish in some of these cyclical laggards, and we have obviously some bias towards quality as a way to kind of help us to manage this uncertainty.
Emmanuel, thank you so much for all of that insight. Emmanuel Coder, Head of European Equity Strategy at Barclays, and Ross Matheson, our EMEA News Director. Now, coming up, finance ministers from the world's biggest economies are meeting in South Africa. We'll report live on what's on the G20 agenda. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question. It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back, everyone. Now, the world's most powerful finance ministers and central bank governors are gathering in South Africa for the G20 meeting. Attention firmly focused on limiting the fallout of a global trade war. Now, South Africa's central bank governor says tariffs are adding to an uncertain outlook.
In the case of South Africa, the biggest impacts had come through the automotive industry and the agricultural sector. The issue about tariffs also raises important issues. We are having to grapple with what would this mean for the outlook of the U.S. economy and the posture that the Fed might take. It is not clear where we would end up. Uncertainty abound.
Now, for more, our chief Africa correspondent, Jennifer Zabasaja, joins us from Palito in South Africa. Jen, good morning. So what is the sentiment on the ground there about current trade tensions?
Right, Francine, I mean, if you talk to many of the officials on the ground, they're not going to deny that, of course, there is the focus on these trade tensions, of course, as we continue to inch closer to that deadline, especially if you talk to, we spoke to Governor Kanyaho, as you were just playing there, and he mentioned that there is a lot of uncertainty in terms of their outlook and the forecast as central bank governors, but still, there is at least an opportunity and a willingness, that is what he was saying, by a number of these G20 countries to sit down and actually talk about some of the issues that they have and potentially ways in which they could find some consensus. He did caveat that, though, with saying that whether or not they come up with a joint communique that they can agree on by the end of this summit is sort of up for the taking. And so we'll wait to see whether or not that actually plays out. But it's interesting to note here, because this is only the second summit that we've seen happen since the tariffs have been instituted. Of course, we don't have U.S. Treasury Secretary Scott Bessent here. The U.S. is represented by an undersecretary in the Treasury, and so the U.S. still is represented. But South Africa went into this G20 presidency with a number of issues, focusing on issues for the global South. And the question is whether or not they're actually going to be able to get some of these other bigger G20 members to agree on some of the changes and some of the priorities that they have prioritized with this G20 presidency, namely MDB reforms. There's also debt sustainability, climate finance. And so over the next 2 days, we're going to be paying close attention to some of the talking points from the central bank governors and the finance ministers. They're going to be speaking about some of those topics, also talking about things like cross-border payments, navigating AI and how that is working in the workforce. But again, the question is, will we see President Trump, U.S. President Trump, at the Leader Summit later this year, ultimately when the U.S. takes over the G20 presidency? And what does all of this mean for multilateralism more broadly, and how each of these different member countries participate with each other and also deal with these multilateral institutions as well as their own domestic issues at the same time?
Jen, thank you so much. Terrific briefing there. Jennifer Zabazaja, their Chief Africa Correspondent. Now joining us is Robin Niblett. He's Distinguished Fellow and former Chief Executive at Chatham House. Robin, thank you for joining us. I mean, diplomacy is changing. For the worse, for the better, I'm not sure yet. But how do you see, just the trade and tariff, I guess, weight on everyone's shoulder changing allies?
I think that we're in a world in which the U.S. has stepped back from providing a kind of balancing impact on international diplomacy. The whole definition of a hegemon is a country that can afford to not always win. But of course, Donald Trump is about always winning. And once you get into that kind of position, it means the United States is not good at working right now with allies. If you're not working with allies, you're trying to win lots of bilateral battles. Bilateral battle with the EU, with China, with Russia, with Iran. But without allies, my sense is America's not winning in any of them. It's in big fights, but it doesn't have people at its side, which means everyone can try it on. Russia can try, see how far it can push the United States. Iran can see how much it can resist the United States. The EU is trying to resist in the trade negotiations. So I'm afraid we've entered a very unpredictable period where the United States, the change in its whole leadership style on international diplomacy, makes solutions, sustainable solutions, very difficult to maintain. Never mind the fact that multilateral institutions, as we just heard, have no power in this environment.
But are we really witnessing a deglobalization, or is it just that the pool of capital or the rule of allies is moving away from the U.S.?
No, it's a good question. I, like others, reckon we're seeing some deglobalization from a global north-led world economy, which, after all, created some pretty crazy things. The bulk of high-end semiconductors taken from a small island whose status is contested by its big neighbor, Taiwan, China, on a fault line geologically. Who thought that up? The bulk of processed rare earth minerals from one country that's in a geopolitical contest with the world's biggest market. Who thought that up? So we are in a position right now where there is a redesigning of global supply chains, but it is creating opportunities for countries across the global south to trade more with each other. We're seeing some more regional integration in ASEAN. We're seeing China shift its trade patterns from America to ASEAN, even a bit away from the EU. So I think we've got a redrawing of global trade, more emphasis on services, more government interventionism, but it's all not net zero.
How do you see U.S.-China? And I was surprised yesterday to see a reversal from the White House in allowing NVIDIA to sell some of their, really advanced chips to China.
In my sense, yes, the United States has been trying to find a balance. The Biden administration had this famously called a small yard with a high fence, very targeted types of tech restrictions. The Trump administration seemed to be going wilder. They want to win the AI race with China. There's a very strong China hawk instinct across most of the U.S. body politic, except, I think, Donald Trump, who'd like to do a deal. And we're seeing that in what you just described. But ultimately, I think the more interesting thing is China doesn't want to depend on the U.S. anymore. The split is China's been taking its time, trying to do it subtly under the surface. But we're now seeing China, as I said a minute, trying to rebalance its trading position, not rely on U.S. tech, because they know at any point, maybe a successor to Donald Trump could pull that away from them. They are going deep to take on U.S. and tech, complete vertical supply chain for semiconductors and for the AI base they need for their economy. So I think it doesn't need to blow up. It doesn't need to become the big fault line of global geoeconomics, but it's inevitable that China's going to try and pull away from America.
But does it also mean that actually China steps into places where the U.S. is retrenching?
Yes. I mean, the problem with China is that its offer is not supremely attractive. America has the world's biggest consumer market. Most emerging markets want to start selling their exports. The problem is China wants to accrue the commodities of global south countries, turn them into high value-added products, and sell them back, all sold to the rest of the world. That's not a good proposition if you're in the global south. So I think things like, less reliance on the dollar, anti-sanctions, new forms of Belt and Road infrastructure investment, more sort of build, operate, get your money back, less debt. I think China's trying to find new ways of filling in the American gap, but its proposal, its offer, isn't as attractive as many would think.
So if you were sitting in Europe, the UK or France and Germany, and it's exciting to see the Chancellor Merz arriving in the UK today, do you have to choose between the US and China, Or can you play a little bit both?
Look, I think, like everyone, Europe also doesn't want to choose right now. The top of Europe's list of hierarchy, top of its list of priorities, is Ukraine. And Europe cannot keep Ukraine sovereign without American help and American engagement, even if we have to buy the weapons. So that is a disciplining force on a Europe that would maybe like to be a bit more pragmatic, triangulate a bit more between the United States and China. So that's why I think at the moment, no, Europe will not choose. And if it's forced to choose, it'll have to lean to America, even if it's to try and look beyond Trump and hope they get a better deal in the future.
When you look at leaders around the world, Robin, is there a friendship or something that still is perplexing? I know there were a lot of questions on what Donald Trump is doing with Vladimir Putin. That seems to have now separated. Could it come back? Like, what's the relationship that you want to know more about?
I've always seen the Trump-Putin relationship as less to do with notions that the Russians have got something on him and he's, trying to make the deal, and more that Trump likes to deal with other people who are strong men. So he'll deal with Xi, he'll deal with Putin, he'll deal with Kim Jong-un. It's much more of a comfortable kind of relationship within the EU, this amorphous, non-sovereign entity, which he just has no affinity for. I'd say more he kind of loathes. So we are seeing more big power relationships. The problem is in America, the leader tends to move on. Whereas in other countries, you've got consistency. So America can't really play that game. You can play it for a brief period of time, as we've seen with Trump, but it's not sustainable, and they know that.
But Robin, how do you understand what Donald Trump is trying to do? Because I keep on hearing from all corners that no matter what he does is, but he cares about the markets and he wants the peace prize. I mean, he's much more complicated than that.
It's more complicated because it's instinctive, but his instincts contradict. So that's kind of difficult. I'm a man, I'll make a decision by gut instinct. Well, that's fine if your gut instincts tend to lean in one direction. But it's 1 minute I want to win against China. It's another minute I want to do a deal with China. 1 minute is we've got to be all right with Putin because otherwise I've got to be nice to him or I won't get a deal. Next, he's not doing a deal with me. I want to be tough on him. It's very complicated. But I think ultimately Donald Trump wants to seem to be a winner. If he's winning, he'll go with the flow. If he's not seen to be winning, he'll change tack. But the ultimate outcome, obviously, is a stronger America, but it's an America where he looks stronger. That's almost more important than a stronger America. Sorry, but I think it's very, very personalized.
That's so interesting. Robin, thank you so much, as always. Robin Niblett there, distinguished fellow and former chief executive at Chatham House. Now, coming up amidst a slump in private equity exits, EQT has defied the downturn by reporting better than expected results. We speak to the company's new chief executive in an exclusive interview. That's next, and this is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. President Trump says he's not planning to fire Jay Powell after speculation about the Fed chair's future sent jitters through financial markets. President Trump eyes a tariff rate of up to 15% for more than 150 smaller trading partners, while also softening his tone on China. Plus, the world's biggest contract chip maker, TSMC, raises its outlook in a big boost for global AI spending hopes. Now, Swedish private equity group EQT reported better than expected underlying profit in the first half of 2025 as it exits more businesses. Well, joining us now is Per Fransson, the chief executive of EQT. Mr. Fransson, thank you for joining us. You're a newly appointed chief executive of EQT. You're in a firm that actually delivered some pretty good results. How does it feel to be in charge? Any surprises? And what's your biggest hope for the future?
Great to be on the show. No, it feels great to be stepping into the CEO position. I've been with the firm for quite some time, close to 20 years. I think we're in a really strong position. It's an interesting time for the industry. It's an exciting time for our firm. Thanks to our global geographic diversification, I think we continue to execute in a very strong way, also in the current volatile environment. And you see that reflected also in the numbers that we're presenting today, putting 7 billion euros of capital to work in attractive thematic investments across strategies, across geographies, and importantly, also sending 13 billion euros of proceeds back to our investors as we continue to stay disciplined in monetizing deals.
Per, where do you see the biggest opportunities, given all of the uncertainty, all of the tariff talk, and question marks about inflation and the like? Is it ripe for new deals? Are you finding them easily, or is there actually a lot of other rivals that also want similar deals?
Well, like you say, it's certainly a volatile and an uncertain environment, but that volatility also creates opportunities, in particular for us, thanks to that global platform that we have. We have hundreds of investment professionals on the ground across Asia, across Europe. We try to leverage that strong local presence with our thematic investment approach to unlock also opportunities in these times of volatility and in certain places also market dislocation to help us invest in some of the most attractive opportunities that we've been following for years and sometimes decades. And at the same time, we're also staying disciplined in realizing deals, and in certain parts of the world, capital markets are actually pretty strong.
So EQT was recently ranked the second biggest PE firm globally by capital raised over the last 5 years. Do you expect to be the #1 slot under your leadership?
I think we're in a really strong position. I mean, the proposition that we have to be one of the scale players in the industry that is really focused on delivering global alpha to private market investors is a differentiated proposition. On top of that, we are one of the few scale players that is not US-centric. And in the current environment, as investors across the world are again focusing on the benefits of portfolio diversification, geographic diversification, I think that is an opportunity for us to continue to scale all of our existing strategies and to continue to take market share.
Per, what about strategic M&A? Is there anything that you'd want to buy right now?
Well, what I would say, taking a step back, right, because of the market volatility and the slightly slower deal-making environment, we have seen a bit more of a challenging fundraising market. And at the same time, there's also a need to really invest into strategic growth opportunities for us as a firm and for the industry, AI, private wealth, the democratization of the asset class, and not all players will be able to make those investments. So we do think that the consolidation of this industry will accelerate, and we want to continue to play an active part in that consolidation.
How much of a headache for you are uninvested funds?
Sorry, I didn't catch that question.
On uninvested funds. So there's some analysis by Bloomberg Intelligence saying that CVC and EQT have the most uninvested funds in the peer group at $57 billion. How much of a headache is that?
I'd say it's an opportunity, right? I mean, having that dry powder in this market environment with the strong platform that we have, I think it's a very good time and a real opportunity to also put that capital to work. And we see a very attractive pipeline. In particular, I'd highlight the opportunities that we see right now across Asia in places such as India and Japan. So I think that's a real strength of ours to have that dry powder.
Per, when you talk about opportunities in India or Asia, is there any type of sectors that you see good opportunities? And is it on price or just because they can grow?
We are a sector-focused thematic investor. And we apply that approach really across all the regions as we're investing. In Asia in particular, we're excited about some of the more domestically focused businesses in those target sectors. For instance, in the technology sector, but also within industrial tech and other focus sectors of ours, right? And then leveraging that thematic investment approach with that strong local presence across the region creates those opportunities.
Per, one of the other things that we noticed is in June you announced a big reorganization. Where did you see the company needed change, and what else do you have planned?
I mean, at EQT, we've seen a lot of success. We've seen a lot of growth over the last 5-6 years, and as a result of that, there's also always an opportunity to sort of revisit your setup, your organizational design. At EQT, we have a saying that everything can always be improved everywhere at all times. So it's with that mindset that also during the transition period and during my first 100 days. We've revisited the organization, and there was an opportunity to simplify things, reduce complexity, and as such also reduce the size of the executive committee, the leadership team, from 10 to 8 participants. And with this new setup that we have, I think we're really well positioned to be able to continue to scale and also participate in the ongoing consolidation of the industry.
So is that it in terms of reorganization, or is there even going to be more streamlined for here in the second half of the year?
I mean, we're a performance-oriented business, right? And so, like any professional services business, I mean, there's always an opportunity to to run things in a more efficient way, in a better way. On top of that, you have all of the investments that we're making into AI and other productivity enhancing initiatives. We do believe that over time that should allow us to operate in an even better, more efficient way.
Per, it's pretty incredible. Since the company IPO'd in 2019, you went from 7 billion euros in market cap to 40 billion. And I think it was really this month that you also got included in the OMX 30. Is that, how important is that for the team and also for your journey?
So the way we think about it at EQT, and the way we've thought about it really since our IPO, is that we just want to continue to invest into our platform, develop the best possible platform in the industry. We know that way we'll be able to continue to attract and retain the best talent in the industry, and that way also produce really attractive results and return for our clients, for our investors, and then the result of that will be shareholder value creation. So we will continue to have that mindset also going forward.
Per, thank you so much for your time today. Per Fransen, they're the chief executive of EQT on the back of results. Now, on to geopolitics in Germany, or politics in general. Germany has rejected the European Commission's €2 trillion budget proposal just hours after it was announced by Brussels. The pushback by the EU's largest member state points to the battle ahead for the Commission as it tries to get buy-in for its next 7-year budget, which begins in 2028. Well, let's bring in Suzanne Lynch, our Brussels bureau chief. Suzanne, thank you for joining us. So how big of a blow is this for the EU?
Well, it certainly is. This EU budget that was announced yesterday here in Brussels is just the start of this process. So the European Commission suggests this amount, 2 trillion in this event, and then it's up for European member states to look at this over the next year and a half, 2 years, to try and get an agreement. So in one sense, the fact that this huge number, 2 trillion, was a big increase on the previous long-term budget. The fact that that has got pushed back is not that surprising. The Commission usually goes up quite high because they know that this will be whittled down ultimately. However, I think it is significant that the German government felt strongly enough that they put out the statement late last night. Interestingly, Ursula von der Leyen, the European Commission President, is German herself. She's a German politician and a member of Friedrich Merz's party. So, questions have to be raised here about what was the communication like. Was Germany not expecting this big figure from the European Commission? Should they have known more that this money was coming, that this proposal was coming? One of the issues, of course, is that the EU budget is, for the most part, funded by member states, and Germany, as the biggest European countries, gives the biggest amount of money to the EU budget. So the higher the budget, that is going to impact countries like Germany.
And Susan, meanwhile, the EU Trade Commission has also gone to Washington for talks with his U.S. counterpart. So can we actually expect a deal?
Well, the mood music here is very much that the European Union does want to continue negotiating until that new August 1st deadline. There is no doubt that Donald Trump's threat of new tariffs of 30% last weekend did unrattle people here, did unnerve Brussels and EU negotiators. However, they're saying they still think a deal can be done. But we're also reporting that there is a move now from some EU countries, led by France, that the EU should employ their toughest tool in their trade toolbox, known as the anti-coercion instrument, that they should activate this if there is no deal, if we get to August 1st and there is no kind of agreement, even if it's provisional, with the United States. So I think there is a kind of a dual track here. Steady as it goes, the EU is still trying to negotiate, but it's also warning that it can hit back if it comes to that.
Here is your startup's million-dollar question. How can you pitch investors with maximum impact? A. Slideshows.
Each other in case of armed attack. The German Chancellor Friedrich Merz, who's visiting the British capital, has vowed to join forces with the Prime Minister Keir Starmer to confront challenges like Donald Trump's trade onslaught and the war in Ukraine. Now, coming up, Wall Street banks report record revenue hauls as they reap the benefits of volatile tariff-fueled trading. The details next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Earnings season is here.
The focus is on the European earnings space.
A busy week of corporate earnings.
We're going to be deeply into a lot of these earnings stories.
Bloomberg is first to break the numbers.
Santander, Caixa, Soc Gen,
Deutsche Bank, HSBC, BBVA.
A slew of bank earnings already out.
With the smartest insights.
There's an earnings revolution going on.
Markets are going to be driven more by earnings.
It looks like the worst is behind us.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back, everyone. Now, TSMC has raised its outlook after posting another set of stellar earnings. Now, second quarter net income, gross margin, and sales all beat earnings, while beat estimates, while operating profit jumped 62% year on year. Now, let's get more from Bloomberg's MEA tech team leader, Amy Thompson. Amy, thank you so much for joining us. I mean, there's really quite a lot going on, but where's the growth coming from?
Yeah, I mean, this is something like the 4th consecutive quarter of more than 50%. It's all coming from AI. They're a key supplier to the $4 trillion company NVIDIA. Every time NVIDIA gets a new order for GPUs, that goes back to TSMC.
So how does it compare with ASML? Because ASML yesterday was a worry, and it's one of their key suppliers. They reported yesterday. So how do you match up the two?
Yeah, so ASML is one step back in the supply chain. Again, they make these big machines that cost $100 million, and they produce the really high-end chips. But they don't just supply this AI boom like TSMC and NVIDIA. They also supply the Intels of the world and the Samsungs of the world, and they've had a much harder time, a lot more uncertainty around tariffs and how it's going to impact sort of the end markets of consumer electronics. A lot more wariness about actually spending money on one of these big machines. So the CEO yesterday basically said, you know, I can't promise any growth for 2026. I don't know what the impact is going to be.
So how might this week's news around NVIDIA's H20 chips sales to China also affect TSMC?
Yeah, it's really, really interesting. So NVIDIA had come up with the H20 chips specifically to sell into the Chinese market, only to be told you can't sell it into the Chinese market. So it's obviously a huge reversal and great news for NVIDIA that this is open to them again. China is a huge market for AI. But what we might be dealing with, one, they don't have licenses yet. So nothing's moving yet. Though I think Jensen Huang said yesterday that he expects it to happen soon. And two, there might be an inventory buildup. So we might not actually see anything being ordered up right away.
So interesting. You're in the space at the moment that everyone wants to know about. Amy, thank you so much, as always, Amy Thompson. And we'll also have an interview with the TSMC CFO, Wendell Huang, which airs tomorrow. Now on to banks. The Bank of America chief executive has stressed the importance of an independent Fed as a long-running rift between President Trump and the central bank chair, Jay Powell, intensified. While speaking to Bloomberg, Brian Moynihan also discussed his company's second quarter earnings beat.
This quarter was the trickiest quarter to get through because year over year, we finally got some NII growth, but year over year, the markets business doing strong, so expense growth was a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
When you talk about 2026, one of the things we're going to have is, in all likelihood, a new Fed chair.
There's been a lot of talk, even today in Washington, about the Fed chair. And you've said you believe in an independent Fed. But if, in fact, President Trump gets his wish, as is his right under law, to appoint a new chair who will be more in line with his views, he said he thinks the interest rate really should be at 1% or even below that. Is that good for Bank of America? Is that good for the economy?
Well, let me make two things. One is you're absolutely right. In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency, and they're meant to be outside the purview of the executive and the Congress. They are called to task, and they're monitored, and they're reviewed, and all the things. But the reality was it's set up to be independent, so that our central bank in America was independent. So I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision, because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly. On the other hand, if you think the prior Fed has been slow to lower rates, you might lower them faster. Our team believes that the Fed will lower rates in the second half of next year by 100 basis points. No change until then, because inflation is still going through the system. That brings the Fed funds rate down closer to 3, which they think is probably more of a long-term rate, and frankly is more similar to what we had for most of American history. What's been unusual is the period after global financial crisis, a very low interest rate structure. That is really not a good place to be, honestly. We'd rather have a higher interest rate structure, a little more inflation, a little more robust economic growth. So I think everybody has to be a little careful about keeping that engine going.
Well, that is the Bank of America Chief Executive Brian Moynihan speaking to Bloomberg and our David Weston. Now, meanwhile, Goldman Sachs stock traders have posted the largest quarterly revenue haul in Wall Street history, raking in some $4.3 billion on volatility sparked by the Trump administration's trade war. Now, across the top 5 U.S. banks, first half trading revenue surged by $10 billion year over year. Well, joining us now is Tom Metcalf, our EMEA Finance and Investing editor. Now, Goldman and Morgan Stanley surprised to the upside on both trading activity as well as investment bank. I mean, it's like party like it's 1999. What drove the strength?
Yeah, these banks put out some really big numbers. It's on the equity side, particularly for a Goldman. I mean, they were up 35%, so record quarter, and impressively $600 million above what analysts were expecting on that front. So it's the volatility driving it. It's all the kind of capital market movements and stuff like that. But you look at the fixed income side, pretty much across the board, the banks are putting up big increases. So I'd say almost every bank is probably sitting pretty in the US at the moment.
Yeah, and we heard from the Citi Chief Executive, Jane Fraser, that volatility is a feature, not a bug of the new world order. I mean, are we going to continue seeing this in earnings to come?
I think so. Great news for if you're a trader on any of those floors. But yeah, effectively, the world has got a lot more complicated, a lot more volatile, and as those decisions reach through, clients are obviously reacting, and that's great news for the bankers.
But, I mean, automatically there are other places of the business where it's more tricky, right? I mean, is it always guns-ho, or is it also because we're expecting deregulation in the U.S.?
Well, as part of that, the flip side of that is the risk, right? It's now a lot more risky, and we just heard, CEO of Bank America, they're going, look, there are sort of warning signs or concerns you might have, even as they say the American consumer is, standing strong at the moment. So it's right now, it does feel like it's a sweet spot, and it'll be interesting to see, how, as things develop, like, will one side pull down the other, or, will they be able to kind of float along at the moment, despite all the sort of incredible news that keeps on crossing the wire.
Tom, thank you so much. Tom Metcalf, there our EMEA Finance and Investing team leader. Now, markets in the U.S. whipsawed on reports that the Fed chair, Jay Powell, was about to be fired. Now, they quickly recovered after Donald Trump denied the reports. Let's bring in our Bloomberg and live strategist, Ven Ram. Ven, first of all, thank you for joining us, but how did you see yesterday? Because I don't know whether, Donald Trump was testing markets to see how they would react or whether he really meant it. And again, all asset classes behave so differently.
Morning, Francine. Thanks for having me. I think that he was trying to test what the markets would do, and he was also trying to jawbone Powell into quitting on his own accord, because it's not going to be easy for the president to push out Powell by law, because it's not an easy process. But interestingly, we saw the Sell America trade come back, albeit briefly. bonds being sold off, dollar being sold off, stocks being sold off, but they've got a respite now. But the question is, I think that the markets are kind of still underpricing the risk that Powell could quit on his own accord because of the pressure brought upon him. And if that happens, I think that there is a risk that interest rates could go down immediately because the next successor is going to be someone who's decidedly dovish according to Trump's preference. So I think that the markets are underpricing that risk. But even so, 1 year from now, it's definite that we'll have someone who's going to drive interest rates lower. And what does that mean for America, corporate America? It means that, we are going to have a lower benchmark rate. But, is there a risk that, they are going to lower the benchmark rate even in the face of a hardening inflation? And that will set up the tension in the market where we have a lower benchmark rate but a higher yields actually.
So are there really any real alternatives, to the S&P?
Well, I think that, the markets have been frothy for a long time, and I think that investors should kind of look further afield. And there are two viable spots here. One of them is India, because, if you look at the risk-adjusted returns on India over the past quarter of a century, a long enough stretch of period, and if you look at that, the risk-adjusted return is higher and superior in India. And I think that, given the growth prospects that India has and given how frothy U.S. stocks are, I think that, investors would do well to look elsewhere other than just the U.S. If they are averse to adding on emerging market risk, they could look at Germany. I mean, here is an economy that is not growing very fast, but at the same time, it offers persuasive value. You're getting the German stock market at nearly 60 cents on the dollar, whereas you have to pay $2.25 to get a dollar's worth of earnings in the US, and that research is out there on the terminal today. So I think that there are compelling pockets of investment corners elsewhere in the world.
Ven, as always, thanks so much. Bloomberg MLive strategist Ven Ran. Up next, Bloomberg Brief, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look at what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stocks rise and the dollar bounces back just a little bit following a brief drama, you could say, over Fed Chair Jerome Powell's future. Also, patient Fed speak. And the latest on trade. President Donald Trump floats 10 to 15% tariffs for more than 150 nations. And earnings continue. TSMC boosts its sales growth outlook as AI orders run hot. So let's take a look at how that is impacting the markets as we approach the open in just a few hours' time. We see very, very small upside for futures. That's after a very whippy day yesterday, of course. The possibility of an imminent ouster of Fed Chair Jerome Powell was in the market yesterday. Will it percolate into today's session? We'll have to see. We'll have to see if Donald Trump makes more comments to that effect and what kind of notes are floating around Wall Street. We saw mainly the reaction in bonds and FX yesterday. There's also the idea that TSMC's outlook is providing some optimism. Of course, NVIDIA still has to report. Will that percolate also into the U.S. session? It certainly had a good impact on the Asia session. As you can see, the two-year yield is still at 390, so not much movement after we saw that steepening of the curve yesterday, a twist steepening no less. In fact, the 530 spread was at 108 basis points, which is the widest we've seen since 2021. So it was quite the market reaction from those pieces of drama, let's say, inside and outside the Oval Office. The 10-year yield at 446.94 and the 30-year yield still above that 5% mark, 503.13. So we will be very much watching what the bond market in particular does in today's session. Let's get down now to some individual stocks to watch, and let's get over to Bloomberg's Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with United Airlines. They reinstated their guidance, citing decreased uncertainty, better travel demand, but this reinstated guidance was lower than their rosy first quarter outlook at the beginning of the year. We're seeing those stocks drop 3% in pre-market trade. Let's move on to more the agricultural industry. We're seeing Archer Daniels Midlands. This is a main producer of corn syrup, falling 5% in pre-market trade. This comes after Trump declared on Truth Social that Coca-Cola would start making its sodas using cane sugar instead of corn syrup, which ADM makes. We did hear a comment from Coca-Cola. They said, be aware there are some new products coming out. Also, let's take a look at the stocks reporting today. We do have a fair few. The big one being before the bell is PepsiCo for maybe a guide on the consumer appetite. We then have GE Aerospace also before the bell. And later today, Netflix reports after the market close. Bonnie.
Fantastic, Valerie. We'll be watching all of that throughout the day and much appreciated. And joining us this hour, George Saravelos of Deutsche Bank. He's warning, of course, of major market consequences if Trump does indeed fire Powell. And we dig into the resilience of the U.S. economy with JP Morgan's Sitara Sundar. So the drama over firing Chair Jay Powell calms down potentially for a little bit now while President Donald Trump continues to pressure the Fed chief. George Saravelos of Deutsche Bank had weighed in on the market implications of any potential change at the Fed, writing this, quote, "In extreme cases, both the currency and the bond market can collapse as inflation expectations move higher. We consider the removal of Chair Powell as one of the largest underpriced event risks over the coming months." George joins us now. He's Global Head of FX Research at Deutsche Bank. So, George, we got a potential preview of what might actually happen should the Fed chair either end up getting fired or resigning. Was yesterday's market reaction what you might have anticipated?
So we published the note you cited over the weekend and didn't expect these headlines to come out so quickly. We wrote that within 24 hours of such an announcement, the dollar could fall 2 to 3%. And I think if you look at the orders of magnitudes of the moves, both in fixed income and in currencies, they were very similar to what we're anticipating. They were very large. Of course, they subsequently reversed because of the denial. But I do think this underlying story, so long as it lingers, it will weigh, it will act as a big headwind both for the dollar and fixed income until it gets resolved one way or another.
Yeah, for sure. And we'll see what happens with market reaction today, because it is constantly percolating through the market, this narrative, right? Every time it goes away, it comes back. I'm curious, the closer we get to actually a rate cut, does it make it less pronounced if there is a change at the head of the Fed?
So I do think we have to separate the issue of who is appointed, and they may lean dovish, they may lean hawkish, but if the appointment process is orderly, at least this retains the so-called institutional credibility of the process. It prevents uncertainty. And then we have to distinguish between that and the more disorderly situation where Powell potentially is asked to leave. And in that scenario, Powell could potentially refuse to do so. You may be in a situation where you're in a legal standoff between the Fed chair and a potential new appointment that could last for weeks, even months. And that is a really bad scenario. So I think, as you say, if we go closer to the date where Powell anyway is closer to leaving, that at least should remove some of that extreme tail risk and the risk of institutional duress for the Fed, which I think would have a very negative market reaction.
Now, the twist that we saw on the curve yesterday was fascinating as a reaction, because it's not necessarily what the president would want in a scenario where there was a different head of the Fed, right? I mean, obviously, we saw lower end yields move lower, front end yields move lower and back end yields move higher, but it's the 10-year and the 30-year and everything that's dependent on mortgages and so on that the president wants lower. So is that any indication that, you know, he wouldn't get what he wants from the market anyway?
I think absolutely, and it's one reason to question whether he would ultimately follow through with these threats, because we fully believe such a move would be counterproductive. I can't stress enough how much the US is exposed at the moment in terms of its external vulnerabilities. So if you look at the situation where you have a fiscal deficit that's likely to be somewhere in the range of 6 to 8%, depending on what you assume around some of these forthcoming tax cuts and spending cuts. So a fiscal deficit of 6 to 8% of GDP, a current account deficit of 4 to 5% potentially of GDP, and then an external position of nearly 100% of GDP. And these are numbers that you don't see in any other developed market economy or in an emerging market economy, and they just point to the vulnerability in terms of being reliant on foreign funding and the vulnerability of the loss of Fed independence. So it would be counterproductive, and I think that is likely one reason why potentially the president would not follow through. But as we can see, the probability is not zero, and the market is pricing off probabilities.
And, you know, participants in the market are questioning if there are other scenarios where he might need something like this in order to take the spotlight off a different narrative, let's say. So there might be a whole different reason for him to actually, you know, mess with the Fed, as it were. Lael Brainerd, to your point, was on Bloomberg Television yesterday, and she said, look, the Fed cannot subordinate its mandate to debt management. Is there any formation of a Federal Reserve, any hypothetical Federal Reserve formation where debt management would be a consideration?
I think President Trump, via his appointment powers, can for sure lean the Fed one way or another. So he can have influence, and you can see that in market pricing, where the curve has, the money market curve has a so-called kink in the second quarter of next year when the new Fed chair is meant to take hold. But I think if you take a step back and you look at what historically happens in situations where you have very high debt loads and a restructuring is out of the question, which I think we should argue is the case for the US. Well, we get a combination of financial repression, which is effectively the government in direct or indirect ways forcing the domestic private sector to absorb more duration and more debt. So it starts with the banks, and we're seeing some movements around shifts in bank regulation to encourage the banks to absorb debt. And it means also negative real rates. So rates are lower than they should be. You effectively lose money when you own fixed income instruments, and effectively the value of the debt is eroded by inflation. So I think that's the broad direction of travel we're going through. Now, how aggressive or disorderly the moves can be in that process will absolutely depend on President Trump and the White House.
And who it might be exactly. So given that, you think about FX all the time, the dollar index, the DXY down 9% already this year, the BBDXY down just less than 8%. I'm curious as to your outlook for the US dollar and what other currencies might benefit from dollar weakness, given that I know you have to also take into account tariffs and we don't even know what they'll finally be yet.
So we're going through a period of consolidation at the moment in the market, but our view is very much one of a structural dollar downtrend. And at the core of the view, it goes back to this issue of twin deficits. The market has revised down its willingness to fund the size of these US twin deficits, partly in response to these uncertainties you alluded to. One is trade, one relates to the Fed. But I think there is a broader macro picture taking place. And if I was to summarize it into two parts, in the US, the dominant macro force at the moment, I think, is a negative supply shock. And there is a very large discussion on tariffs and the back and forth. But the bigger shock is taking place in the labor market and in immigration. And if you look at some of the shifts that are undergoing that are likely to hit the economy in the second half, we're talking about a very, very sharp reduction in labor force growth, which I think will have a very real impact in terms of the GDP growth numbers. So that's a negative supply shock in the US, while in the rest of the world, fiscal policy is expanding. We're seeing a positive demand shock. And if you combine those two with the twin deficit discussion, I think the dollar path is still lower.
All right, George, thank you so much. You were pretty prescient this week with your notes, so we'll be on the lookout for the next one. That's George Saravalos of Deutsche Bank. Now on to other top stories trending on the terminal this morning. TSMC sees sales growth of about 30% this year, shoring up investor confidence in the global AI spending spree. The chipmaker's CFO did warn that the company's third quarter performance could face a bigger hit from a strong local currency. JP Morgan racked up a $30 billion profit in the first half, more than double its closest rival. It further widened its lead over Goldman Sachs and Morgan Stanley in investment banking revenue. The bank's market value now exceeds that of Bank of America, Citi, and Wells Fargo combined. Meanwhile, Wall Street banks are missing out on millions of dollars in fees after Couche-Tard abandoned its bid to buy Seven & I Holdings. The year-long pursuit could have been the biggest foreign takeover of a Japanese company, but it ended in acrimony, with the Canadian chain blaming the 7-Eleven owner's board for, quote, obfuscation and delay. Coming up, President Trump lays out a potential tariff from more than 150 nations. More from Washington and also from the G20 next. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Earnings season is here.
The earnings are front and center. The slew of results already out.
Are tariffs going to eat into margins?
Bloomberg is first to break the numbers.
JP Morgan, Citi, Wells Fargo,
Bank of America, Goldman, Morgan Stanley.
I'm getting my spreadsheets ready.
With the smartest insights.
It's going to be a can-kicking situation.
Expectations are relatively low.
The market is looking for confirmation of that growth narrative.
Continuing coverage on Bloomberg. Context changes everything.
For all of us who are exporting to the country that imposes tariffs, there is an impact on output. The issue about tariffs also raises important issues. We're having to grapple with what would this mean for the outlook of the U.S. economy and the posture that the Fed might take in terms of monetary policy. It is not clear where we would end up. Uncertainty abound.
Well, he said it. Uncertainties abound. That's the South African Reserve Bank governor speaking to Bloomberg at the G20. President Trump, of course, eyeing tariff rates of 10 or 15% for more than 150 countries. He said, quote, don't do much business, while talks continue with more significant trading partners for the United States. Let's bring in now Bloomberg's Brussels bureau chief, Suzanne Lynch. So, Suzanne, what's the latest on the EU trade talks? Do these letters somehow supersede what's going on there?
Yes, well, as we heard from President Trump here, there is a sense from Washington that they want to focus discussions on those bigger trade partners, and the European Union is one of those partners. I think it's fair to say that the European Union was very unnerved by the threat last weekend by Donald Trump to impose 30% tariffs. They had thought that the negotiations with Washington had been going relatively well, and they had been hoping to sign a provisional agreement. That has not happened, but they're still saying here in Brussels that they do want to get an agreement before August 1st. So this week we have senior officials from the European Commission, including the Trade Commissioner, Maros Sefcovic, is in Washington. He will be speaking to Mr. Greer, Howard Lutnick he spoke to earlier in the week. So the negotiations are continuing. At the same time, a lot of countries here, including France in particular, are saying, look, the EU is prepared to hit back if it doesn't agree a deal by August 1st.
Yes, so just another few days, really. It's, already the 17th of July. And then pressure from the Oval Office on Fed Chair Jerome Powell as well has been rising in recent days. Trump denied, of course, looking to fire him yesterday. Have a listen.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him. But they did. So, we're not planning on doing anything. We're very concerned.
It's this constant drip, drip, drip of derogatory comments, right, Suzanne? And, you wonder, even though we saw the market react yesterday, do markets believe Donald Trump yet that, he won't fire him, but there's always the possibility he might?
Yeah, I think there is an argument that perhaps the markets are pricing in the Powell effect at this stage. There has been so much commentary from Donald Trump, so much seesawing on this issue that they are expecting some kind of change on this, and they're already looking to see who might be that replacement. Now, yesterday in particular, there was a very swift reaction to that report that Donald Trump was preparing, had a letter, was preparing to fire him. Then, of course, as we know, Donald Trump pulled back from that. But I think markets are watching this closely, and I think one of the concerns will be if Trump does decide to pick a loyalist, someone like Kevin Hassett, for example, who's had a long relationship with Donald Trump and was central as an economic advisor in the first Trump administration. If he does pick somebody like that, will the independence of the Fed still, be upheld? They're the kind of issues I think that markets are looking at, but are keeping a close watch on what happens there.
For sure, and 2 more days this week to see some market reaction. Our thanks to you. That is Bloomberg's Suzanne Lynch. Meantime, the world's most powerful finance ministers and central bank governors are gathering in South Africa for the G20 meeting. Attention is focused on limiting the fallout of a global trade war. For more, let's bring in Bloomberg's Oliver Crook. He's on location there at the G20. So, Oliver, what are you hearing? Is the fact that the U.S. finance minister isn't there, is that dominating the discussion of everything, or, is it in the background?
So there are two sides of this, Vani. On the one hand, there is the agenda here for the G20, and on the other, there is what's happening in Washington, D.C., in the White House that is basically governing all discussions everywhere in the world, certainly in finance ministries across the world. And the finance ministers I've spoken to so far, and the ones that we'll be speaking to a little bit later throughout the next couple of days, are squarely focused on two things. On one, the trade war that is ongoing now with the United States, trying to get that deal now with that deadline less than 2 weeks away. And of course, also the criticisms and the potential firing of Jerome Pal. Just yesterday, we were listening to that press conference after we saw all these headlines crossing about the potential firing of Jerome Powell. I was about to sit down with the Norwegian finance minister. His currency moved by 1 percentage point in the wake of that. And I asked him, how concerning is this to you in terms of global market stability, that these are the sorts of things that are going on? And that is very present in the minds of the finance ministers here. On the question of trade, and this is, I think, a really critical point here, there's going to be a question in the next couple of weeks of how the Europeans, the EU, can escalate pressure on the United States if they do not make any progress in these trade negotiations. And from what I am hearing today is we will have a meeting today from the European Commission and a number of representatives here from Germany, from France, from Italy, also with Canada, Japan, and South Korea. So this is building sort of a narrative and a conversation that we've been asking about for a while now, which is if there is a failure to make progress in negotiations with the United States at the EU level, could they band up potentially with countries like Canada, like Japan, like South Korea, in terms of having a collective approach with the United States? No one has been very open about talking about that because they don't want to upset Donald Trump, but that potentially is one of the conversations we're going to be having here at the sidelines of the G20.
Ollie, thank you so much. We'll be checking in with you periodically throughout. It's just getting started, really. That's Bloomberg's Oliver Crook at the G20 in South Africa. Coming up, PBS and NPR are set to lose federal funding from DOGE cuts. More on that, and what else is making headlines around the world. This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York, in for Danny Berger. Time now for our front page news, a look at what's making headlines around the world. First up, a Wall Street Journal exclusive. U.S. officials are stalling a UAE Nvidia chips deal over security concerns. Some Trump officials are concerned that China could get access to cutting-edge U.S. technology. Commerce Secretary Howard Lutnick met with representatives from the UAE and discussed how to move the agreement forward. Next, on the Washington Post, the Senate narrowly passing President Trump's bill to cut spending. The Senate voted 51-48 to approve the cuts to the Public Broadcasting Service, National Public Radio, and to foreign aid. The bill now heads to the House, which plans to send it to President Donald Trump's desk before a Friday deadline. And on the New York Times, immigrants filing a class action lawsuit to stop ICE courthouse arrests. A civil rights group sued the Trump administration over the agents detaining immigrants who were appearing for court dates. The lawsuit calls the detentions unlawful and a violation of due process protections. Let's get a check on markets now, just a few hours before the U.S. Open. We do have S&P futures pointing higher, just fractionally. Dow futures are also just a little higher, and Russell 2000 futures a little lower, mirroring a little bit what happened at the close of yesterday's session, also on a little bit of optimism from TSMC results. And if you take a look at the 10-year yield, not much movement, not much give back after yesterday's price action. Coming up, we're going to be catching up with JP Morgan's Sitara Sundar on the resilience of corporate America. This is Bloomberg.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Vonnie Quinn, standing in for Danny Berger, who is on assignment, and this is your Bloomberg Brief. Here's what you need to know. Stocks rise and the dollar bounces back following a brief drama over Fed Chair Jerome Powell's future. Also patient Fed speak. And the latest on trade, President Trump floats 10 to 15% tariffs for more than 150 nations. Also, earnings continue. TSMC boosts its sales growth outlook as AI orders run hot. So let's take a quick look at how markets are digesting all of this. It looks positive, at least for equity indices in the early going, with S&P futures and NASDAQ futures higher. Remember, they did resume their gains yesterday after that brief, well, I don't want to call it drama. It does percolate through the market day after day these days. Russell 2000 futures still lower, however. Let's move on to the bond market, because we saw much more of a massive reaction in bonds yesterday. Right now, we're not seeing too much give back, with the 2-year yield still at 390. The 30-year yield still at 502. So it was a 108 basis points spread between the 5 and 30-year at its peak yesterday. We haven't seen that since 2021. We'll be keeping an eye on bond market action today. And of course, plenty of auctions next week as well, which we'll be watching. So let's get down to some individual stocks to watch now and get over to Bloomberg's Valerie Teitel. Valerie.
Good morning, Vonnie. Let's start with some companies who released earnings after the bell yesterday. That was United Airlines. Those shares are trading down around 3%. They did reinstate their guidance, Vonnie, but it was a bit on the lower end and not as rosy as their Q1 outlook from the beginning of the year. So those stocks are trading lower. Let's move on to the agricultural industry. We are seeing makers of corn syrup struggle this morning, one of them being Archer Daniels Midlands, down over 5%. This comes after a Trump post on Truth Social saying that Coca-Cola has agreed to use cane sugar in its soda rather than corn syrup. Coca-Cola did respond, saying beyond the outlook for some new product launches. Lastly, let's end with some stocks to watch in terms of who else is reporting this morning. We do have PepsiCo before the bell with maybe a guide on U.S. consumer activity. GE Aerospace is also a big one reporting before the bell. And then after the market close, we get Netflix. Funny.
Definitely ramping up into earnings season. Valerie, thank you so much. Valerie Teitel there. And as she said, earnings season in full swing at this point. We'll hear from regional banks, Pepsi and General Electric this morning, Netflix after the market close. For more now, let's bring in Sitara Sundar of JP Morgan Private Bank. She's on set with me. So we know that we've seen some fairly good earnings so far. It hasn't been terrible, right? And your base case does suggest that earnings will support this market, but your base case is also at the high end where the market is at right now.
Yes.
So what does that suggest for the rest of earnings season?
Definitely. So I think first, thank you so much for having me. I love being here. I think there's two things that we're looking at when we think about what is going to propel equity markets moving forward, where we still have a positive outlook and we still expect mid-single-digit growth over the next year. So there's two things: what's happening in the economy and ultimately what's happening with earnings. So far in the economic growth front, we are seeing slowing, which is baked into our base case expectations, but we're still seeing resilience, and our base case is still for moderating but positive economic growth. We don't think the U.S. is going to enter a recession this year. On the second side of that, it's earnings, and we're, as you mentioned, in full swing when we think about earnings season so far this year. And when we project out over the next year, there's a couple of things that we think are going to end up driving earnings at the end of the day. One, we still think that tech and comm services are going to lead the way, and we still think that the profitability, net profit margins, and earnings outlook, especially when you think about CapEx and the growth behind artificial intelligence, is going to propel those two sectors moving forward. But the second and extremely crucial part in terms of what we're looking out for this earnings season too is participation and durable earnings growth in other sectors. So financials, we still feel positive about. Utilities, we still feel positive about. And if we look at calendar year 25 and calendar year 26, we're still expecting mid-single digit to low double-digit types of earnings growth over the next couple of years. And that's going to be because more sectors are participating.
How can you be so confident in that outlook, given the amount of tail risks out there, whether it's inflation, whether it's a change at the Fed, whether it's, slowing growth, as you said, or just simply that CapEx comes back in and companies decide that they can't afford, with all the tariff uncertainty, to make these big pronouncements? Look,
it's the right question. There are the confluence of factors that we've seen so far this year: heightened geopolitical uncertainty about the duration of uncertainty around trade policy, what tariff risk is actually going to mean. But I think we also need to take a step back and think about the health of the corporate sector that we've seen, not even this year, but really over the past few years. Net profit margins have been above the historical average, the historical 5-year average, 1. 2, we also need to remember that this is not the first trade-oriented uncertainty that this corporate sector and the economy has experienced so far. So if we take a step back and think about the 2018 trade war, and then also the COVID supply chain disruptions that we've seen there too, there's already been a playbook for a lot of these corporations on reorganizing supply chains, reshoring some of this kind of domestic manufacturing type of activity, for one. And then 2, because we're positive on earnings growth moving forward, it doesn't mean that there's going to be pockets of the market that are not going to hurt. Some of these cyclically oriented sectors, commodity oriented sectors, are areas that we're actually avoiding at this point in time. And where we're actually focusing moving forward are more of these cycle agnostic secular opportunities. And we're paying attention to CapEx spending. We're going to be paying attention to guidance so far this year, but we still think AI is here to stay. We still think that it's a trend that is going to permeate across all these different sectors, which will shore up earnings growth over the long run.
But you are moving to software over semiconductors.
100%.
Shifting. And as we know, just a few months ago, the AI narrative went completely away when the tariff narrative came to the fore, and we're not certain that we're done with the tariff narrative yet. So you do also suggest some global diversification.
100%.
But where would you go in an environment like this?
It's the right question. You're asking all the right questions. Look, I think there's 2 things. One, the global diversification point is a public and private conversation, which we can talk about. We're talking about that. When we think about where we're finding the opportunity set, incrementally more positive on Europe across both public and private markets, and incrementally more positive on Japan as well. I think the amount of corporate governance reform, M&A reform, and the opening up of a lot of these management towards profitability and corporate profitability, and the increase in ROE that we've seen within that space is not really being discounted in markets right now, given all of the noise around trade policy uncertainty, what's going to happen on that front. So when we think about that incremental opportunity, we're still constructive on Europe, and we're still constructive on Japan. And we think that in a period of time where we have seen meaningful U.S. exceptionalism, if you think about the past 10 years and the dominance of mega cap tech, we still think that the U.S. has legs and that there's room for outperformance, but we're going to start to see those earnings growth differentials start to narrow.
When you're looking abroad, how much do you have to take into account currency differentials? How much does that really just end up being the deciding factor in whether you invest in a particular company, be it public or private?
It is something that you have to consider. Currency differentials, what's been happening with dollar weakness, and actually what we've been seeing is the impetus behind the international diversification story has been twofold. One, the revitalization of the European economy and fiscal stimulus and defense spending that we're seeing there too, but also this need for a lot of our US-based clients and US dollar-denominated clients to be diversifying their currency exposure too. So it's definitely something that you have to think about when you think about the relative value of both of those regions. But at the end of the day, everything that we try to do is trying to shift and see the signal through the noise and focus on the fundamentals. You can't just buy a market solely for the currency appreciation. There needs to be a durable story there. So we see that on both fronts.
And the other part of this change in portfolio from the 60-40 to sort of a more, maybe spicy portfolio where you can definitely count on some things at least, is you say infrastructure.
Yes.
That's sort of a no-brainer. Why though?
It's, when I think about the next decade, it is going to look extremely different than the prior decade. So what do I mean by that? We're going to be having moderating economic growth, whether it's at potential or below potential, we'll see. But the two biggest factors that are going to change likely is that rates are going to stay higher. Even if we see base rates come lower and the Fed cut, it's likely that rates are going to stay higher for longer in this cycle than it was in the past cycle. And inflation is likely going to be stickier in this cycle than it was in the past cycle. So when we think about that moving forward, the definition of what a resilient portfolio and a durable portfolio is for the next decade is going to have to change in lockstep. So infrastructure is something that we've been increasingly excited about because of a handful of reasons. One, it provides inflation-resilient income backed by multi-year contracts and contracted cash flow. So you know that income and therefore those total returns are going to be durable. And over the past 10 years, we've seen infrastructure, especially on the private side, clock in about 10% annualized returns, which I think surprises people. But also, two, when you think about everything that is happening in this ecosystem right now, about artificial intelligence, one of the biggest things that we've been talking about over the past couple of years is the power that's needed to fuel that.
For sure.
So when you think about the sector breakout within infrastructure as well, it used to be extremely transport heavy, toll roads, ports, and things like that about a decade ago. But really over the past couple of years, and even zooming out 5 years, power has become an increasingly bigger portion of that sector, and it's actually 60% of the global infrastructure ecosystem at this point in time.
And that's definitely going to be part of the AI conversation.
100%.
Sitara, we have to leave it there, but we could totally speak for hours about this new type of portfolio that you're designing, and looking forward to the next time. That is Sitara Sundar of JP Morgan Private Bank. Now, on to other top stories trending on the terminal this morning. Citigroup and Wells Fargo are the latest to join a surge in Eurobond issuance by U.S. issuers this year. U.S. issuers raised 27% more selling Euro currency bonds so far. The reverse Yankee debt market is heating up, driven by cheaper Euro funding costs, dollar volatility, and anxiety over tariffs. A record share of American firms froze investments in China as trade ties worsened earlier this year. According to a recent survey by the U.S.-China Business Council, fewer than half of the companies surveyed plan to invest in China in 2025. This is a record low. Not since 2006 have we seen these levels. Couche-Tard abandons its bid to buy Seven & I Holdings. The year-long pursuit could have been the biggest foreign takeover of a Japanese company. The takeover bid ended in acrimony, with the Couche-Tard crew blaming the 7-Eleven owners' board for, quote, obfuscation and delay. Coming up, Trump versus Powell. The president denies he's trying to fire the Fed chair. More on the White House pressure campaign next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
the day?
I did. It was a busy day.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
We are in very close contact both with the European Union, we are part of the internal market, but also with the United States. We have, what should I say, a good tone. We are addressing some real issues, and again, it's too early to conclude, but the ambition is to prevent increases in the tariffs.
That was Norwegian Finance Minister and former NATO head Jens Stoltenberg speaking to Bloomberg at the G20 gathering in South Africa on, of course, trade uncertainty. Bloomberg's Brussels bureau chief Suzanne Lintz joins us now. Suzanne, President Trump has said he's eyeing tariff rates of 10 to 15% for more than 150 countries, and those letters have started to go out. What do we know about that set of nations?
Yes, we heard this from President Trump yesterday, the latest kind of salvo as it continues this very aggressive trade strategy. And from what we gather, this are smaller countries, he said, probably smaller countries in Asia, up to 150 who will receive these letters. Now, if previous patterns are anything to go by, in one sense, we're hearing some feedback that would suggest that this could be a good thing for some countries who maybe believe that Donald Trump wants to wrap this up, that he's putting that number out there, and that there is room for negotiation on this to get it over the line by the August 1st deadline that he has set. For example, we saw that with Indonesia. They, quite quickly have struck a deal with Trump after a previous threat. So in one way, there could be a silver lining to this, but it does speak to the continuing uncertainty about what's next on the tariff front.
And then, Suzanne, what about the European Union, one of the largest trading partners for the United States? I thought that the negotiations were sort of coming to a head. Does these letters supersede that in any way, or how does it all come into the mix?
I think for the moment, Donald Trump made it clear that these were going to be smaller countries that would get these letters. And he did mention in those same comments that he was still negotiating with the EU and implying that something could be perhaps done relatively quickly. In saying that, I think there's growing nervousness here in Europe, particularly since Donald Trump threatened those 30% tariffs last weekend. That was a bolt out of the blue to a lot of the negotiators here who thought they were close to a provisional deal with Washington. Now, there's a two-track approach, if you like. On the one hand, the European Union is continuing with the negotiations, is saying that it is hopeful that a deal can be reached by August 1st, a provisional deal. On the other hand, however, they are quietly preparing other possible sanctions that could be used if this deal is not agreed by August 1st. So I think we're hearing growing number of voices here. France, from the very beginning of these trade negotiations, has been arguing for a bit more of a robust response by Europe. Now we're reporting that at least a half a dozen other countries are agreeing with them, really. So they are getting together and coming up with a plan that they could impose further actions, perhaps ultimately on US services, if a deal is not reached. But at the moment, they're still saying that a deal is in reach, and we have top EU trade negotiators in Washington this week hoping to make some progress.
Yeah, and August 1st isn't until tomorrow in 2 weeks, so plenty of time there. The other narrative is obviously the pressure from the Oval Office on Federal Reserve Chair Jerome Powell. It's been rising, it seems, in recent days, even though it's been percolating for months. But Trump did deny looking to fire him yesterday. Let's have a listen.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him. But they did. So, no, we're not planning on doing anything. We're very concerned.
Markets reprice every time something like this happens. What do you think markets believe right now, Suzanne?
Yeah, there was a real flurry of activity yesterday with those initial reports that Donald Trump had a letter that he was preparing to fire the federal chairman. But of course, as we heard there, he wrote back on that. In one sense, I think we're seeing a possibility the markets are kind of pricing in the Powell effect at this stage. There has been a lot of over and back by Donald Trump on this, and I think there is an expectation that there will be movement on this sooner rather than later, despite that denial by Donald Trump yesterday. Of course, the big question is then who gets the job? Does he put in the place of Jerome Powell? Now, there are certain names, Kevin Hassett, for example, a real Trump loyalist, someone who's had a lot of experience in driving U.S. economic policy under the Trump administration, both the first Trump administration and the second. So he is emerging as a key figure here who could be set up as a successor to Powell. Of course, the big question is for a lot of investors is whether Fed independence will be maintained in that event. So I think they're the kind of questions that markets are looking to be answered sooner rather than later.
For sure. Suzanne, thank you so much. That is Bloomberg's Suzanne Lynch in Brussels there. TSMC raised its outlook for 2025 revenue growth. It seals sales growth now of about 30%. Joining us now is Bloomberg intelligence analyst Charles Shum. That 30% was even characterized as conservative, Charles. Also, margins were better, so it seems like it was pretty much all good news from TSMC. What should we take away from it?
I think actually from this increase of the sales guidance indicate that the AI chip, first thing, most important is many people who are concerned is about the AI chip demand. Actually, that indicate that the AI chip demand is actually ongoing strong and will continue still be strong possibly in the 2025 second half. That's the most important question that the sales guidance answered. And also, this also indicates that there's a clear validation of the TSMC's competitive position in the advanced node manufacturing. And that's the second thing that we get from the new sales guidance number.
Now, there was a mention of NVIDIA. TSMC said it hadn't received a signal from NVIDIA. Do we know how it's going to play out with the H20 chip and what we can learn about NVIDIA?
Oh, that's a very good question. Yes, the management mentioned that they haven't pricing that the new approval from on the H20 chips because we believe that many of these H20 chips shipment coming essentially will deliver from TSM from the NVIDIA's warehouse instead of a new order placed to the TSMC. But still, we think that this actually H20 chip delivery resumption is a very good news for TSMC because if NVIDIA are going to ship more AI chip, that actually still relying on TSMC to produce this and actually increase the coming 2026 growth prospects.
Yes, indeed. Charles, thank you. Certainly in the pre-market, we have NVIDIA higher and also, as you saw, TSMC higher by more than 4%. That is Bloomberg intelligence analyst Charles Shum. Coming up, we'll get you set up for your trading day with more earnings and more Fed speak. That's next. This is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg. Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in for Danny Berger in New York. Now a look at what's ahead today. We'll get U.S. retail sales and jobless claims data. That's at 8:30 a.m. Eastern Time. Then Fed Speak coming from Kugler, Daly, Cook and Waller throughout the day. A big day for Fed Speak. Big day for earnings too. They continue with Netflix reporting after the close. So let's have a look at the movements of some of those that did report already. United Airlines lower in pre-market trading after the carrier cut its adjusted earnings per share forecast for the year. Archer Daniels Midland sinking after Trump said Coca-Cola pledged to use cane sugar in Coke beverages sold in the U.S. And Sarepta soaring after cutting more than 1/3 of its workforce and adding a black box warning to its gene therapy. Now let's have a look at how we're shaping up for the trading session. As you can see, we are still fractionally higher for S&P futures. The dollar index up higher as well. That's primarily thanks to the euro and the British pound. The sterling is weaker today after some data out of there. The U.S. 10-year yield is still at 446.53, backed off just a tiny bit, but we will certainly be watching yields today for any more Powell fallout. That's it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Positioning continues to chase higher. That has been the key driver of the market rally and the reason why equities have been able to defy all odds.
The momentum's coming from different directions. Is it enough to kind of turn the tide where the whole economy benefits? I think the jury's out on that.
One of the main risks that we saw were high valuations in a very concentrated market. We still have those same exact risks.
We think it's broadening this year. Equities are a great asset to capture that expansion.
The onus now is on the earnings and growth story.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, playing games with Chairman Pal.
He's a terrible Fed chair. I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. We're not planning on doing anything. We're very concerned. It's highly unlikely. Unless he has to leave for fraud. He's a knucklehead.
President Trump stopping just short of attempting to fire Fed Chair Jay Powell as the White House is preparing to slap 10 or 15% tariffs on more than 150 countries. One senior central bank official is doubling down on restrictive monetary policy. The tension continues to build.
The tension is building, Jonathan, between the White House and this Federal Reserve. And at the same time, you have the Federal Reserve Bank of New York president coming out and saying, quote, maintaining this modestly restrictive stance of monetary policy is entirely appropriate, which goes to the heart of really the president's problem. Even if he were to be able to get rid of and have his wish to get rid of Jay Powell, it's a deliberative body, and he might not get the outcome he's looking for.
So many reports. Yesterday was wild. Reports he was about to fire him. Reports he had a draft letter ready to go. We've got a stress test for this market, and I have to say the market moves. Directionally, I get it. Stocks down, yields up, dollar weaker. It was all pretty tame.
It wasn't Armageddon. It wasn't Armageddon. Why? Because the market probably doesn't believe that he was ready to do it just yet. Also, the market might be thinking about what's the legal cause for this? And the Supreme Court has made it clear that the Fed is an entirely independent private entity. So the market right now is not really believing these threats. But what Trump is doing is potentially eroding the public trust in Jay Powell.
Later on this morning, 8:30 Eastern Time, another read on this economy, retail sales, jobless claims. And write this one down too, 6:30 p.m. on the Economic Outlook. Look out for Governor Waller. Will Governor Waller start to lean even harder into this lower rate story?
Because he's one of those individuals that the name is being floated, potentially that could ascend to be Fed chair. And to be honest, if you're looking at what the president is trying to do in terms of where he wants to see interest rates, it would be analytically, strategically smarter for the administration to elevate someone that is already at the Fed. So that extra seat with Jay Powell and then Kugler, they can put two individuals there that potentially have more of their worldview.
This is a volatile news cycle. Look to corporate America for some stability. We heard from United Airlines. Scott Kirby said this: the world is less uncertain today than it was during the first 6 months. Some confidence coming from the airline industry. Lisa's going to catch up with Scott Kirby later on this morning.
This is really an echo of what we heard from Delta. They feel like the worst is behind them. There is a path, they think, of certainty. And also Scott Kirby saying he's confident in a strong finish to 2025. The world is less uncertain today than it was the first 6 months. Covering policy in Washington, D.C., Jonathan, though, still feel like things are uncertain. There's still a lot of T's that need to be crossed and I's to be dots.
Futures right now on the S&P 500 positive by close to 0.1%. Coming up this hour, Brian Levitt of Invesco as the president stops just short of firing the Fed chair. Torsten Slock of Apollo as the White House eyes tariff letters for 150 countries. And Dan Stuyven of Goldman Sachs on why crude prices may rise in the second half. We begin this hour with our top story. President Donald Trump stopping just short of firing Fed Chair Jake Powell. Bloomberg's Mike Shepard joins us now from Washington for more. Shep, that was a wild 24 hours. Just how close are we to firing the Fed chair?
Well, Donald Trump tried to make it seem like we were not as close as the markets had feared earlier yesterday as the reports began to emerge that he had floated this letter to congressional Republicans. And we had even heard from a White House official who indicated that the president was actually preparing to move in that direction soon. Trump attempted to table that idea, and yet at the same time, he didn't rule it out entirely, as Anne-Marie herself heard in the Oval Office yesterday. The president expressed his frustration with Powell over what he sees as the Fed's slow pace in lowering interest rates. He cited the cuts made by the European Central Bank. He also pointed to what he sees as lowering inflation figures, and he also cited the potential cost savings on interest paid by the federal government on its borrowing. And remember, that's a debt pile that's growing thanks to the president's tax and spending plan. Now, look, the president's pressure on Powell right now stands in contrast to the lavish praise that he heaped on him when he first appointed him as Fed chair back in 2017. But he does have the support of a number of congressional Republicans. And that includes the House Ways and Means Committee chairman, Jason Smith, who Kayleigh Lyons and I heard yesterday on Balance of Power tell us that he sees it's perhaps Powell's time to resign, and it's something that the Fed chair should seriously consider doing well ahead of his term ending in May 2026.
The pressure keeps building. Shep, we'll catch up with you in the next hour as we continue to track this story. The president saying to you yesterday he was surprised he got reappointed to a second term. I went back over the vote. 80 senators voted to reappoint Chairman Powell to a second term.
Which is why I think we also need to start thinking about what this hearing could like for the next Fed chair. If it is someone that senators or the market doesn't deem as credible, how contentious potentially could that hearing be? It was smooth sailing for Jay Powell. We should know, too, when he was first appointed, it was under President Trump. Because yesterday in the room, President Trump said, who appointed this guy? And then he realized that might have been me. So who reappointed this guy? Oh, that was President Joe Biden.
Here's the view on Wall Street so far this morning. Brian Levitt of Invesco writing the following: independence of the Federal Reserve is critical, while lowering rates in response to a weakening labor market is a legitimate policy response. Doing so to placate the executive branch is far more troubling. Brian joins us now for more. Brian, good morning. Good to see you.
Good morning.
It's the easiest job in government, apparently. How easy is the next Fed decision?
Well, I think the Federal Reserve is going to continue to focus on this dual mandate. I mean, for me to write that Fed independence is critical, such a bold statement that I put out there yesterday, right? So it is critical. The irony in all this, Jonathan, is that the Fed would probably be lowering rates had it not been for the policies around trade, tariffs. So the Federal Reserve is in a wait-and-see mode. Labor market showing a little bit signs of weakness, but still relatively sound. Inflation expectations pretty stable. So from their perspective, no reason to cut here until we see what the tariffs mean. But the irony, again, is they probably would have been easing had it not been for the tariffs.
The market did get a stress test yesterday.
Yeah.
But I think if you didn't know, you wouldn't have noticed.
No.
It was pretty tame stuff yesterday afternoon. What did you make of it?
Yeah, I was getting texts from friends saying gold prices are going nuts, the dollar's going, and I pulled up the Bloomberg terminal. No, it's not. You know, it was, I think you're right. You said it absolutely right when we came into the show, was that the moves, the direction of the moves was appropriate, but the magnitude was not significant. And I think a lot of it, to Anne-Marie's point, is that the market just didn't fully believe that it was going to happen.
Is the market, though, more primed now if it were to happen?
I think so. I mean, you're not going to get a great outcome in markets if we fire the Fed chair. Right now, you talk about how it has to go through the courts, or other Fed governors could be could stand up to any pressure to lower interest rates. But if the market gets a whiff that we're losing Fed independence, then yeah, it's rates up. And we're in an environment right now where valuations are a bit elevated to be grappling with rates up. So that's not my base case. I think that ultimately we will move through this without firing the Fed chair. But there is that risk.
But the markets now live in purgatory, do they not? Because this genie is out of the box.
Well, we've been in purgatory on a handful of things right now, so I'm not sure that the market is going to be overly focused on this. We're in a little bit of a purgatory on negotiated trade deals as well, and what we saw in 2019 was the market could continue to go up even if we did not get the negotiated trade deals. So, yeah, I think the president is going to use this topic as an ability to try and jawbone the Fed chair, perhaps put the onus on the Fed chair if the economy rolls over, but I don't expect the Fed chair to be fired.
The market gets the vote first. We've talked about this a million times. And sometimes who you appoint doesn't even make it to the Senate. If you go back to the president's first term, who remembers Stephen Moore? Right. The economist Stephen Moore, nominated to be the governor at the Federal Reserve. Didn't happen. That was even with a Republican majority in the Senate. So you can get that kind of constraint, both from the market, one side, and then on the other side from Republican senators.
Basically, the president could, right between now and the end of the year, be putting out a number of trial balloons, one being undermine the credibility of Fed, or potentially saying, do I have potentially the leeway to fire this individual? And then maybe we're going to see a bunch of names pop up, and the market may get a vote, and then the president could decide whether or not he's going to want to go through with that specific person.
Brian, markets are okay. Earnings seem to be pretty decent. We heard from the banks earlier on this week, hearing from others as well, the airlines, talking about a good story in the second half of 25. Do we need those Fed rate cuts?
No, probably not right now. I mean, the airlines are happy. The one big, beautiful bill certainly helps them out. The banks are in a promising deregulatory environment. The volatility in markets is certainly helpful. So you're right. All of that is fine. I mean, you look at the Fed funds rate. Fed funds rate should not be sitting where the 10-year rate is, right? We shouldn't be sitting here with a flat yield curve. So the Federal Reserve is probably a bit tight here and would like to lower rates to a more neutral level. But the reality is we're waiting to see how prominent the inflation is from tariffs. Now, I don't view tariffs to me as a price shock, right? That's not broad-based inflation, but the Federal Reserve is still going to be in wait-and-see mode.
You see that price shock in the data, though. It's starting to come through.
Starting to come through, yeah.
Services versus goods. Yeah. And this is what I think is interesting right now. Goods prices are basically telling the Fed to wait. Services prices are arguably telling the Fed to cut.
Right.
Where do you think they put the greater weight, place the greater emphasis in the months to come?
Well, it all depends on where inflation expectations are. So if inflation expectations can stay relatively stable, and I mean within the bond market, not these surveys that we're doing of consumers, in the bond market, if they can stay stable and you start to see cracks in the labor market, the Federal Reserve will ease. And that's maybe one of our saving graces here. You know, I keep thinking I was born in the 70s, but I don't want to relive the 70s. So, you know, I don't have any polyester leisure suits to go put on. So I certainly don't want to deal with concerns about the independence of the U.S. Central Bank. But the big difference back then was the market believed that we should be raising rates, and the Arthur Burns Fed did not want to follow through with that. The saving grace, or perhaps a little bit of a silver lining here, is the market is expecting lower rates. Now, we don't want that to come because the president is pressuring it, but nonetheless, the market is expecting lower rates.
That might be where we land by the time we get to September, which is only a few months away. Brian, I appreciate it.
My pleasure.
Thank you, sir. Brian Levitt there of Invesco. The latest from the New York Fed President, John Williams. I expect those effects from tariffs to increase in the coming months. Maintaining this modestly restrictive stance of monetary policy is entirely appropriate. They're going to keep poking the bear.
And they basically keep punting the ball back to the White House, saying, if for us to move lower in rates, we're going to need you to set the tariff policies. And right now, what do we have? We only have 3 basically deals that are done. The president is in active negotiations with the U.S. biggest trading partners, and he's saying that he's going to set a base rate of 10 to 15% for the 150 other partners. Until the Fed has those rates, how do they start to model out what this one-time price shock could actually look like?
Equity futures this morning, just about positive. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Joining us now, here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump said he's not planning to fire Fed Chair Jay Powell. He made the comments to reporters in the Oval Office following reports that he had discussed the idea with a group of Republican lawmakers. The president added, I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud, referring to his recent criticism of the Fed's $2.5 billion renovation plan. Elsewhere, President Trump says he'll send letters to more than 150 countries notifying them that their tariff rates could be 10% or 15%. He said the new levies will kick in on August the 1st if the countries can't negotiate better terms with the US. The president said that the trading partners that would receive the letters were not big countries and don't do much business with the US. And AI spending momentum seems to be holding up as TSMC raised its 2025 revenue growth outlook. It raised its projection after the chipmaker reported a better-than-expected net income, keeping a streak of beating estimates every quarter since 2021. TSMC said that it'll stick with plans to spend up to $42 billion to upgrade and expand capacity this year. And that's your Bloomberg Brief. John.
Lizzie, thank you. Appreciate it. More from Lizzie in about 30 minutes' time. Up next on the programme, Trump versus Powell.
You drafted a letter?
I drafted a letter.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should.
Up next on the programme, Ed Mills of Raymond James, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Equity futures on the S&P 500 just about positive by 0.05%. On the Nasdaq up by 1/10%. Later on this morning, 8:30 Eastern Time, jobless claims and U.S. retail sales. Under surveillance this morning, Trump versus Powell.
There's lots of reports coming into this meeting that you planned on firing Fed Chair Jay Powell.
Those are reports, but they're not true.
Have you drafted a letter?
I haven't drafted a letter.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of fire him. Almost every one of them said I should.
It's the latest this morning. President Donald Trump calling it highly unlikely he would fire Fed Chair Jay Powell after reportedly raising the idea in a meeting with congressional Republicans. The president adding he doesn't rule out anything. Ed Mills of Raymond James joins us now for more. And welcome to the program, sir. I've been asking this question, just how seriously we should be taking these threats.
Yeah, I think you need to take them seriously because it is being discussed in meetings with lawmakers. I don't think that Trump is likely to fire Powell. What I think this is about is a pressure campaign, either to get him to step aside, maybe get another governor to step down. We've been watching whether or not Michael Barr, who is no longer vice chair for supervision, does he end his term early? We saw that when Powell was getting renominated, where the former vice chair of supervision, Randy Quarles, his term hadn't expired as a governor, but he stepped down to give Biden another slot. And then I'd also look to see whether or not this is about resetting market expectations to the extent that Jay Powell's power is waning. Do we have to over-index some of the statements of the potential replacements for Jay Powell? And is this more about reshifting market expectations versus whether or not Donald Trump is going to fire Powell?
If it's about changing potentially some of the successors, adding more names, who are you thinking of, Ed?
Yeah, I think for me, it is 4 individuals. It's the Kevins, the Kevin Hassert and Kevin Warsh. I put Christopher Waller in that camp as well on the board, as well as Scott Bessent. And what I've always thought is that Donald Trump loves people competing for his attention. He loves people competing for the job, to the extent that he has 1 or 2 slots open on the board, having an opportunity to get those individuals onto the board and see how that they would perform. And I do think that if we're in a situation where we had 2 individuals join the board before Powell's term is up, the Trump nominees would have a majority because he had 2 from his first term as well. And so those are going to be those market shifts that occur that the market is going to be paying attention to, Anne-Marie.
Do you think this pressure campaign is going to work, not just on Jay Powell, but some of the other individuals you're mentioning on the board?
You know, my view is that this pressure campaign could backfire. When I had conversation with my contacts here in D.C., what they tell me is because of this pressure campaign, the Fed is going to be more insistent on being, quote unquote, data dependent. And then you have another decision of President Trump, which is to punt the implications of this trade war and what the tariff rates are until at least August 1st. And so if the Fed is being data dependent, it's going to take until probably September, October, or later for them to get the data about the impact of these tariffs, Anne-Marie. And so is the July rate cut off the table? Is the September rate cut off the table? Do we have to go all the way to December? And so if President Trump had set tariff rates earlier and just left the Fed alone, I think there would actually be a higher probability of a rate cut sooner rather than later. This here might actually have a big unintended consequence of the Fed waiting much longer than what Trump actually wants.
A lot of people on Wall Street, Ed, they agree with you. Neil Dutta of Renmac might be one. Anne-Marie, Neil said this yesterday. The upshot of all of this is that it makes Trump's first pick more challenging to get through, going on to say that might ultimately force him to go with Governor Waller.
Exactly, because also Governor Waller is going to help them potentially add more individuals to the board. And you've said it a million times, Jonathan, the market is going to have a vote, and then you're going to have a hearing. And who can make sure they can get through Congress right now, given all the drama surrounding this pick?
Ed, Secretary Bessent said the process has started. The formal process has begun. Ed, what's your read on how long this process is going to take and how close we are to a final decision?
Yeah, I think it's going to be, do we get a governor pick first? And then we would see the opportunity to have one of the individuals I discussed getting on the board sooner rather than later. But I don't think there's going to be a kind of formal pick, the revelation of who this is, much closer to the expiration of Powell's term. Maybe I'm wrong in that fact that, Trump doesn't fire Powell, but he instills that quote unquote shadow Fed chair. I don't think the market likes that, John. And I don't think that, the intended consequence of lower rates would be the result of those type of moves.
If the president was to go with his Treasury Secretary Scott Bessent, who pretty much made it clear to me, John and Lisa, that he was part of the decision-making process, it didn't sound like he was still really in the process to be the next Fed chair. But if he were to go with him, what kind of other obstacles does that create for this administration to then fill his role?
Yeah, so I think in D.C., anytime someone is in charge of a process, you always look to see whether or not they end up with the job. It's the kind of Dick Cheney effect is what we always discuss that as, so I don't dismiss that at all. People have asked that question because since April 2nd and the market reaction to the tariff nominee, kind of reactions there, people want Scott Bessent leading those negotiations. So if he does leave and go to Fed chair, people are going to ask very quickly who replaces them. Mark Rowan always comes up in conversations because he was on the short list, but the market desperately would want someone that they were comfortable with in the Treasury Secretary role. So it is a bit of a mixed bag if Bessent does move over to the Fed because of how important he has been to this administration in his role as Treasury Secretary.
When it comes to the tariff rates as well, the president yesterday was talking about 10 to 15% for, say, 150 countries. How close is he, though, to actually end up striking the deals with the U.S.'s biggest trading partners?
I think it's actually pretty decently on track to at least get those MOUs, Anne-Marie. And I was actually thinking about a conversation you and I had kind of back in April where the original goal, or what Scott Bessent thought was going to be announced in the Rose Garden, was 10% across the board, 20% for bad actors, or those with our biggest trade deficits. And as we are getting closer to this new August 1st deadline, where you see kind of the trading partners who have the biggest trading deficits, they're settling in around 20%. Those who, kind of UK is the only real example, is settling around 10%. The world that really doesn't do, quote unquote, a lot of business with us is settling around 10%. And then the, middle ground is that 15%. So, we've spent a lot of time round tripping to exactly what was expected to be announced at that Rose Garden ceremony on April 2nd. But the roller coaster ride has been quite wild.
Ed Mills, it certainly has. Thank you, sir. Ed Mills there of Raymond James. I think we all remember the afternoon of April 2nd, initially when we thought it was going to be a baseline 10% tariff. This market actually rallied.
Yeah, it rallied, basically, because everyone thought this is the best of the worst case scenario. And then once the president brought out that big chart, which, by the way, in the White House yesterday, I was peeking in someone's office and I saw that chart on display. I said, oh, the market doesn't like that chart. Then that's when we saw the market look at these rates, how sky high they were for some of these countries like the European Union, like Switzerland, like Japan. And they said, oh, this is way too big of rates than the market can digest. And then what did the president do? He said the bond market got yippy, the taco trade, the Trump put, whatever you want to call it, and then he unwound policy.
He unwound. The Fed's still waiting, and they're not cutting anytime soon based on recent communication. So where do things stand? The president's saying, I hope you resign. And the chairman's saying, I'm going to serve out my full term. And that tension's going to keep on building until this Federal Reserve starts cutting.
And it feels like we're living in purgatory, both as journalists and also in the markets, because every single day that ends in Y, so that's every single day, the president is going to jawbone Jay Powell. First, it was about he's not cutting interest rates and inflation is coming down. Now it's about what is going on at the Fed when it comes to renovations. It seems like the administration is trying to, at minimum, make sure that they are putting this credibility test to the public when it comes to the Fed chair.
Up next on the program, the conversation continues. We'll catch up with Torsten Slok of Apollo on stagflationary fears in the U.S. economy. Plus, Yahara Arnott with your morning movers with a different kind of soda story. PepsiCo numbers dropping just moments ago. Their stock is higher by 2.25%. Live from New York City, the equity market's doing okay. We're positive, just about positive by 0.03%. From New York, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In 2 hours' time, some economic data for you, retail sales and jobless claims at the moment going into that futures, just about positive by not even 0.1% on the S&P, on the Nasdaq 100 higher by 0.15. With 3 hours until the cash open, let's get you some morning movers. We can do that with Yahara Anand. Hey, Yahara.
Good morning, John. We start with the latest U.S. corporate to report, and that is PepsiCo. Shares are up 2% after the company reported better than expected sales driven by international growth. It also maintained its full-year outlook, and that's because one of the strategies that it had mentioned when it last reported is working, which is to provide more pricing options because it had been losing budget-conscious shoppers due to inflation. We turn to another U.S. corporate that just reported, and that is United Airlines, but it is going the other way, down nearly 2.8%, despite the company joining Delta Airlines in offering an optimistic view in the year ahead. Even Scott Kirby said that the world is a less uncertain place, but a few things weighing on the results. It did issue a single piece of guidance, now expecting to earn profits of $9 to $11 a share this year, but that was below the rosy target it set at the beginning of the year, and it's still grappling with the hangover after all those disruptions over at its main Newark hub, which will continue to be a drag on Q3 results. And we end on this stock, Archer Daniels Midland. Shares are down 5.6%. The company makes high fructose corn syrup, and it is falling because President Trump says Coca-Cola is now planning to swap out corn syrup and use cane sugar in its U.S. beverages. This, of course, ties into the Health Secretary RFK Jr.'s MAHA movement and Trump's own obsession with Diet Coke. Coca-Cola says that more details are coming on Tuesday when it reports. John?
Yahara, thank you. Thank you very much. Maybe the most underreported story of this administration so far, the progress they've made to make some of these companies really U-turn on some big issues.
So yesterday was about Coca-Cola, but also a few days ago, it was about what's going on in ice cream. 40 ice cream companies, 90% of the producers of ice cream are saying we're going to get rid of the dyes that we put in some of our ice cream, and they're going to work on that for the next few years, and that's been a huge push of this administration.
Might actually help sales of Coca-Cola as well.
Yeah, probably,
Apparently it tastes nicer, so we'll see. On a radar this morning, President Donald Trump saying he has no plans to fire Fed Chair Jay Powell after reportedly running the idea by a group of Republican lawmakers. The president saying it would be highly unlikely unless Powell would have to leave his role due to fraud.
So that interesting moment there, due to fraud, I think the administration is trying to build this case. They couldn't win when it comes to just going after the Fed chair for not cutting interest rates. They are really leaning heavily into the renovations that are taking place at the Fed. You did see Jerome Pal calling the inspector general to make sure that all of this is above board, trying to understand about the swelling cost of this renovation. But you can see they're needling at anything they can to really try to get at Jay Powell, potentially even try to just put pressure on him to resign himself. He is not resigning. The Supreme Court talks about the independence, the private entity of the Fed. So right now, what the president is dealing with is just going to be constant bashing of the Fed. And yesterday came to this extreme with reports that he was willing to pull the trigger. But was it just a trial balloon?
There's some tension in Washington between the Federal Reserve and the White House. There's also some tension in the data between goods prices and services prices. And that tension is not going to go away this summer, which makes the September decision all the more important. You get to September, they're not cutting rates. If you think things are firing now, it's going to get even worse.
It's going to be much harder for them. And really what the Fed is going to continuously push back on, what we heard from Williams yesterday, is we are still waiting for the final implications of tariffs. And at this moment, we don't have the final tariff rates from this administration. We just have the fact that they are talking about these deals and he's planning to send more letters, but we don't have the finalized products.
Let's get to some of those letters. The president preparing to send letters to more than 150 countries, announcing tariff rates of 10 to 15%. Trump saying the tariff rate would be the same for the group of countries, which he described as not that big and don't do that much business with America.
I feel like we're back on the campaign trail when all we heard from the president and the reporting was a 10% tariff wall around the United States and potentially as high as 60% when it comes to doing business with China. What you have here is something a little bit in the middle, 10 to 15% for all of these countries, but a handful of America's biggest trading partners, Japan, India, South Korea, the European Union, Mexico, Canada. These are the countries they're in active negotiations with, and of course, China is going to be a longer-term story.
That volatility continues, but corporate America's doing okay. United Airlines shares are a little bit lower after the airline cut its earnings per share forecast and narrowed its profit outlook, but United expected a rebound in travel demand for the second half. The CEO, Scott Kirby, saying global uncertainties have decreased. They've got some clarity on the future that many other people don't. We'll be catching up with Kirby later on this morning. Lisa sitting down with him at 8:45 Eastern Time.
Really looking forward to that conversation, because how do you go from a U-turn of at one point issuing 2 earnings scenarios because you didn't know where the economy was going to go, dictated a lot by the policy uncertainty in Washington, D.C., and pretty much saying we turned to the corner and we're expecting to have a really strong year. We heard that from United, and we also heard that from Delta.
This airline shaking off the tariff story big time as the president said he would send letters to more than 150 countries notifying them of their tariff rates. Torsten Slok of Apollo writing, a trade war is a stagflation shock. Torsten Slok joins us now for more. Torsten, good morning.
Morning.
Is firing the Fed chair a stagflation shock?
Well, so a stagflation shock is by definition that inflation will go up and GDP growth will go down. But if you fire the Fed chair, as we saw yesterday, the dollar will likely go down. And at the same time, long rates will be going up. And the dollar going down is certainly inflationary. But rates going up is, of course, holding back growth. So firing the Fed chair will probably mainly mean a decline in the dollar and an increase in long rates.
Let's talk about the stag versus deflation. Do you expect to see that inflation for very long?
Well, so far there's a number of FOMC members, when they talk about this, that they discuss what is the persistence of the stagflation shock. In other words, when tariffs start to be more visible in the data. And I absolutely believe the data we just got this week, it is the case that we're now seeing lift off in inflation in goods, because we are seeing goods inflation, which makes up 40% of the CPI basket, seeing on a number of different categories, tools, toys, apparel, furniture. We've seen a fairly decent rise. And if we begin to see that lift off now over the next several months, then the risk is, of course, that this becomes more persistent. And Beth Hammack from the Cleveland Fed has said that in her district, companies that are exposed to tariffs have been raising prices, but even companies that are not exposed to tariffs have, for competitive reasons, also been raising prices because, hey, if others are doing it, we can also do it. So the fear at the Fed is that this does become more persistent and more sticky. So that's why it's so difficult for the Fed to go out and declare victory and say, oh, this is just temporary. They need to wait to see the peak, and we are really only at the takeoff stage. So we have not seen the peak. The consensus expects that later this year, by probably November or December. But the bottom line is, before we can see that peak in sight, it is not clear that the Fed will say that now we're going to cut rates more meaningfully.
How do we explain what's happening with services prices?
Well, so of course, when something has a weight of 40%, and we know very well that that's now going up, of course, the issue is, well, what about the 60%? Is that also going up? The 60% consists to a large degree also of wages. And what we know from deportations, of course, at a run rate of around 1 million people in 2025, that means that wage inflation will likely begin to go up in the areas where unauthorized immigrants are working, for example, in agriculture, construction, leisure and hospitality. So the fear you can have is that it's not only goods inflation coming from tariffs, it's also the upside risk to services inflation coming from wages, especially because of deportations potentially beginning to play a more significant role.
Torsten, is the consumer able to absorb this?
Well, on the retail sales data today, it's quite interesting because the low-end consumer has been in trouble for quite some time because we've seen auto loan delinquencies go up, we've seen credit card delinquencies go up. That's mainly because lower-income households generally have more debt, they generally have lower FICO scores, and when you have more debt and the Fed raised rates in 2022, that means the lower-income households are having higher debt interest payments. So therefore, low-income households have been in trouble for some time. Now, high-income households have been in good shape because stock markets are up, home prices are up. If you own fixed income, the cash flow you get from private credit, public credit, that's been very, very strong. But the middle-income households are now facing the new shock that student loan payments restarted after the moratorium or the pause on paying back your student loan ended here in May. So that means that the rating bureaus are now being told if I'm not paying my student loan. And that means that we are, unfortunately, for the consumer outlook, and therefore for retail sales here at 8:30, seeing the risk that it's not only low-income consumers that are now facing headwinds, it's also the middle-income consumers. And there's about 11 million people who are not paying their student loan on time at the moment, out of 45 million people who have a student loan. So that means with a 25% delinquency rate on student loans, this is at risk of implying that credit scores are going to go down. According to the New York Fed Liberty Street blog post, it could be as much as 75 points on your FICO scale. So people who have a credit score of 725 goes down to 650. That means that middle-income households are at risk of seeing not an ability to borrow, to buy a car, a house, washer, dryer, iPhone. So therefore, the risk to consumption is that it's going to broaden out the headwinds, not only to low end, but also to middle income.
When you look at tariffs as a headwind, if the president is about to potentially settle on 10 to 15% across the board for 150 countries while he's in active negotiations with some of the biggest trading partners, is that enough for the Fed to then start to model out what that could mean and cut rates? What's the timeline between getting the final tariff rates and the Fed being willing to cut?
Yeah, that is really important because the, excuse my picture, pig is coming through the python here in terms of tariffs and what it means. Are companies going to raise prices for consumers? And that's the way we pay for tariffs, or are companies going to take it in earnings? So there are various simulations from the Yale Budget Lab, the Penn Wharton Budget Model, the Tax Foundation, which try to look at what are the implications of different levels of the effective average tariff rate. And those show indeed that it does take time, so the Fed will not have clarity on this issue, maybe not even this year, which is exactly why FOMC members are so reluctant to come up with answers. How do we even quantify what the impact is? And the final point in your world is, of course, also, what about the hearings for the IEPA on July 31st? That's now several weeks away. With that all deemed that there is a risk that this could all turn out to be not legal, what does that then mean for the August 1 deadline? So in the near term, the Fed is certainly going into the July meeting, in my view, thinking we cannot just even signal that there is any rate cuts coming because we just don't know yet the persistence, the magnitude, and therefore overall what are the implications of tariffs at this point.
Can I just deal with that word we? How many people make up that word we? And how many people put their hand up and say, you know what, actually we should cut, and we should cut this month?
Yeah, of course, both Chris Waller and Mickey Bowman have been turning more towards talking about cuts potentially being something that should be likely. But the answer is to your question, at least the vast majority of committee at this point is certainly, at least in the reading, if you look at the dot plot, weighing towards saying, well, there is probably a good argument for waiting.
Median dot still projects, implies 2 cuts. Morgan Stanley, no cuts. Bank of America, no cuts for 2025. What's your base case? Given what we know now, what's your base case?
We have 1 cut in December, but I do think that the market is way too eager to price in cuts. Again, the risks are, and not only we talk about tariffs as upward pressure on inflation, we also talk about immigration restrictions and deportations as upward pressure on inflation. But let's also not forget that if you take Purpose, the Fed's model of the US economy, and you ask the question, what does the Fed itself think is the implication of a 10% depreciation in the trade-weighted dollar? And the answer out of Purpose is that inflation will go up over the next 4 quarters by 0.3. So now we suddenly don't only have the uncertainty about tariffs putting upward pressure on inflation, we also have immigration restrictions putting upward pressure on inflation. And then we also have that the depreciating dollar for the last 6 months is also putting upward pressure on inflation. So all that argues for rates higher for longer. And on top of that, in the long end, we also have fiscal issues putting upward pressure on inflation. So the whole yield curve is likely to stay elevated for a much more extended period than what the market is appreciating at the moment.
The Federal Reserve is projecting transitory. It's just implied by the forecast. Core PCE for 25, 3.1, 26, 2.4, then down to 2.1 in 27. That's the glide path. Do you project transitory?
Well, that is also, if I type ECFC, go on Bloomberg, I see exactly that profile where inflation will peak at 3.3 by Q4 of this year, and then it will begin to come down. But noteworthy is it, including in the Fed forecast, that we will only by the end of next year have inflation still at 2.5%. That's still way above the Fed's 2% target. So you could begin to argue, if you begin to cut rates when inflation is 2.89, or if we get basically a situation where inflation turns out to be more sticky, The risk is, of course, that they will be cutting prematurely. And that's what literally every FOMC member worries about, namely, did we cut too quickly? And are we therefore then creating more boom in the economy, including with the one big beautiful bill lifting GDP next year? We could have a fairly strong economy going into 2026. And with that backdrop, it becomes very difficult to argue that you should see a lot of Fed cuts next year.
Do you think the 100 basis points of cuts in the run-up to the election was premature?
Well, of course, at this point, we have no longer talk about our star as we have done now for a long, long time. And this was the strong argument at the time that monetary policy was restrictive. There even still in the footnotes of FOMC member speeches talks about, well, monetary policy is still today restrictive. But if you look at it that way, well, if monetary policy is so restrictive, why is the economic data then still doing so well? So that suggests that maybe this whole discussion has, interestingly enough, completely faded into the backseat of the car. We're no longer talking about our star and restrictive. Now we're so eager instead to talk about the inflationary impulse coming from, in particular, tariffs, but also the dollar going down. So I think that the debate around why are we at these levels of interest rates and where should we be, that debate seems to be almost yesterday's debate. So that's why I think a lot of the impulse and the discussions on the FOMC now is all about what's coming ahead of us. And what we know is coming ahead of us is exactly what the forecast from the Fed is saying, namely higher inflation. Jay Powell said himself, we expect a meaningful increase in inflation over the coming months. That's a very strong statement from the Fed chair. So I think that we should, in markets, take that very seriously when the Fed chair is staking a lot of credibility on saying we expect a meaningful increase in inflation over the coming months.
Torsten, it's good to see you. As always, thank you, sir. Torsten Slok there of Apollo. If you are just joining us, welcome to the program. Equity futures doing okay, no drama here, just about positive. Later on this morning, I keep repeating this, some economic data for you. The main event, 8:30 Eastern Time, US retail sales and US jobless claims. With an update on stories elsewhere with your Bloomberg Brief, let's cross back over to Lizzie Burden. Hey, Lizzie.
Hey, John. Pepsi shares are rising in the pre-market. The food and beverage company reporting second quarter earnings that beat analyst estimates. Pepsi also maintained its annual outlook, highlighting strength from its international business. And a record share of American firms have paused investments in China as trade ties between the two countries worsened earlier in the year. According to a survey from the US-China Business Council, 27% of companies said that they'd moved or planned to move some operations out of China. Many companies citing China's retaliatory tariffs against the US as their top cost concern. And shares of Seven & I tumbled in Tokyo after Couche-Tard announced that it's abandoning its $46 billion takeover bid. The Canadian owner of Circle K stores says that the Japanese firm refused to engage during an almost year-long pursuit. Seven & I disputes that, insisting that it did engage in sincere talks and is disappointed that Couche-Tard has walked away. And that's your Bloomberg Brief, John.
Lizzie, thank you. More from Lizzie in the next 30 minutes. Up next on the program, the president's push for cheaper crude.
We're number one in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great, and that'll help stop wars, actually, if you want to know the truth.
Up next, we'll catch up with Dan Stuyven of Goldman Sachs. From New York, you're watching Bloomberg TV.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate. Put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Just about squeezed out a day of gains in yesterday's session on the S&P 500. This morning, struggling to add to it. We're unchanged on the S&P, on the Nasdaq higher by not even 0.1%. Under surveillance this morning, the president's push for cheaper crude.
You know, we have the most oil of any country in the world. We're #1 in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great, and that'll help stop wars, actually. You want to know the truth? It's going to help stop wars, and we hope to get it down a little bit more. It's one of the reasons that inflation's in check.
Here's the latest this morning. Oil looking to snap 3 days of losses after a decline in U.S. crude holdings. Dow Stroiven at Goldman Sachs writing, we're nudging up our Brent second half of the year forecast by $5 to $66 and keep our oversupply-driven forecast for crude heading into next year. Dow joins us now for more. Dow, good morning.
Good morning.
Attention seems to be switching from, say, recession watch to supply watch. You've been focused on that too. What should we be focused on now?
Yeah, so, oil prices have recovered somewhat, up 10% over the last 3 months for two reasons. On the physical side, while inventories globally have built very significantly, stocks in the pricing centers in the OECD, especially in the US, are still quite low. And then on the financial side, to your point, market focus has shifted away from downside to demand, from recession risk, to now potentially downside risk to supply, whether it's from Russia potentially or Iran. We are laser focused on checking where these significant global inventory builds that we are seeing, the big surplus that is materializing, whether those builds are going to show up in the pricing centers. Our assumption is they will, and that will put downward pressure on oil prices. But I think that is the biggest question to watch right now.
Can we sit on US supply as well, just for a couple of beats, for a few moments? US supply coming out of GFC was something like 5 to 6 million barrels a day and then took off and has stabilized now at about 13 million, which is an amazing figure. Yeah. 13 million over the last few years. Have we seen the peak now for crude production in America?
Yeah, so crude production did hit an all-time high in April, around 13.5 million barrels per day. But global liquids production, which includes not only crude, but also natural gas liquids, is actually above 20 million. So twice as large as the second largest oil producers in the world, namely Saudi Arabia and Russia. Our view is that the period of very rapid increases in US supply are behind us. We actually have modest declines in our forecasts for black oil US production both this year and next because we look for lower prices. If prices were stable, we would forecast US supply to edge up slightly. But those periods of very rapid supply growth are clearly behind us, in large part because the Permian, which has been the biggest growth engine of US and global oil supply growth, is maturing.
We had 11th week in a row where rigs were down. How does the president then fulfill his drill baby drill when producers are saying, actually, we're holding off right now because prices are too low?
Yes, so the rig count is down sharply, more than 10% on a year-over-year basis. Part of that is structural, because oil producers, on average, every year need 8% less rigs to produce the same amount of oil. Some of it is cyclical because prices are down roughly 10% year to date. If prices stay at current levels, we would expect very modest supply increases from the US. But taking a step back, I think the current price level of oil is pretty close to the sweet spot for the US economy as a whole. Affordable for the consumer and perhaps a touch low for producers, but still above break-even rates for most US producers.
But what would be the price that US consumers want to see to drill more?
That U.S. producers want to see, to dream. I think if you go into the 70s, you should see a more significant rise in production. I think the current price level with TI in sort of the mid-60s is where production moves roughly sideways to slightly higher.
Can I ask you about Chinese demand? We're doing a round the world tour. I just wanted to get to that. Just how robust is that economy right now? What does demand look like at the moment?
Yeah, so Chinese oil demand is up slightly on a year-over-year basis. We think it's still down actually from the peak 1.5 years ago. We think that it's coming in a bit firmer than expected, but I think the two things to note about Chinese commodity demand is, number one, huge divergence, with, for instance, copper demand up more than 10% year to date, but LNG imports still down on a year-over-year basis. China is basically shifting very quickly to electrify its economy to reduce reliance on the rest of the world for oil and gas imports. The second thing to note about China demand is you want to distinguish end-use demand, commodities that you actually burn and consume, as opposed to apparent demand, where a lot of demand is just to refill, restock, and improve energy security. And we have seen a big pickup in crude inventory builds in China, probably for energy security reasons. And so while the US is perhaps scaling down SPR purchases, China seems to be scaling up SPR purchases.
Reporting, they did this as well during the pandemic. What happens if the United States does end up slapping secondary sanctions on China and India because of Russia?
Yeah, so I think that is an upside risk to oil prices. Our base case is that Russia will continue to produce broadly in line with the OPEC plus quota for three reasons. Number one, we think that President Trump and Western policymakers in general are averse to sharp price increases. Second, I think the history of sanctions suggests that Russia and other sanctioned producers are pretty good at finding workarounds, perhaps by giving discounts to buyers, price-sensitive buyers in the East, and by building up an alternative supply chain. And third, Russia may perhaps be too big to sanction. In fact, because Russia is such a large producer, 10% of the global market, if you see a big drop in Russian volumes, prices may go up so much that Russian oil revenues may actually rise. That would be counterproductive.
Dan, it's good to see you. Clinic, as always, Dan Stuyvesant there of Goldman Sachs on a crude market. Crude at the moment, Brent crude, positive by 1/3%, 68.70 this morning. WTI 66.80, also higher by 0.6%.
What's interesting there, Dan, is talking about how Western officials, aka the Trump administration, as well, don't want to see higher crude prices. So they might be adverse to this idea, this bill that's circulating in Congress about slapping those sanctions on, similar to what we saw as well from the Biden administration.
Up next on the program, the second hour of Bloomberg surveillance just around the corner. Mike Wilson of Morgan Stanley, the former St. Louis Fed President Jim Bullard, Robert Koenigsberger of Gramercy Funds Management, and Krishna Mamani of Lafayette College.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Through the economy is still good.
What we see is pretty decent underlying economic growth.
We've dropped our recession probability all the way down to about 20%.
Things are good out there. You know, the consumer is in still a very good spot.
Consumers are feeling okay at present, but this weakening going forward.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Huge distraction yesterday afternoon. Firing Chairman Powell. Will he? Won't he? Will he? Won't he? The president says he won't. Pretty tame price action in the face of all of that, considering the stakes here on the S&P 500 and for the bond market. Squeezing out a day of gains in yesterday's session. This morning, just about unchanged, rolling over into negative territory in the last 10 minutes or so. On the Nasdaq 100, positive by just 0.03%. For the day ahead, lots of economic data 90 minutes away. Look out for this. We'll get jobless claims at 8:30 Eastern Time and retail sales. We've talked a lot about the composition of spending, goods versus services. This is about the rate of spending in America. We'll get some details later this morning.
And how the consumer is really faring right now in the face of some of these tariffs, which under the surface of that CPI report, you saw that tariffs are starting to hit certain sectors. This is the kind of data the Fed is looking for. We heard from Williams yesterday talking about that they think they need to maintain this restrictive policy because they don't have the tariff rates set yet from the President of the United States. And August 1st, everyone is thinking, is it really August 1st, or is this going to be another kick the can down the road, new date and timeline set?
And not everybody has the same opinion of the New York Fed President John Williams. Later on today, 6:30 p.m. Eastern Time, you're going to hear from Governor Waller. Governor Waller's got a very different view on where he thinks monetary policy will be, should be. And when they vote at the end of this month, he might be one of those guys that puts his hand up and says, you know what, I think we should be cutting.
And it's also very convenient because he's one of those names that's being tossed around, that's being written up as an individual that could ascend to become the Fed chair when Jay Powell steps down next year. And this would be interesting for the administration to pick because by taking someone that's already on the board, that means they have another seat to play with. The president noted yesterday that it is a deliberative body. So yeah, they don't like Jay Powell, but at the end of the day, it is not Jay Powell alone that decides where interest rates are going.
You were in the room with the president yesterday. What did you make of all of this? Is this just one great distraction from something else? What is this?
Trial balloon, distraction, you know, having someone like me in there alongside the Wall Street Journal and Reuters when there's all these reports and you're seeing congressmen and women tweet about it that were in the room with the president the evening before and him taking a vote. Should I fire him? Should I not? Was there a letter? Was there not? Huge distraction from other political issues going on, especially within his base, like what's going on with Epstein. And at the same time, he's able to get some data from this. How did the market react? How far can I actually push this?
I hope they haven't learned the wrong lessons from yesterday's price action, because based on yesterday's price action, I think that's nothing like what it will look like if you actually go through with trying to fire the Fed chair. Moves of 0.7% on the S&P 500, moves of 5 to 10 basis points on bond yields at the long end. That's not what it's going to look like. That is not what it's going to look like if you go through with it.
They didn't think it was credible. They said this is another moment of the Trump put, taco trade, whatever you want to call it. He's putting something out there, trial balloon, but he's not actually going to go through with it. And then we all went into the room and he said, no, I don't have plans for that. I didn't even draft a letter. And he actually said to me when I said, so you didn't waive this letter in front of congressional Republicans, he said, no. I asked them what they thought of the, quote, concept. He said they were actually for it. He said, but I'm more conservative than they are.
Many of them voted to confirm him to a second term. Equity futures this morning just turning negative by not even 0.1% on the S&P. Coming up this hour, we'll catch up with Mike Wilson of Morgan Stanley on the resilience of corporate America, the former St. Louis Fed President Jim Bullard on the future of central bank independence, and Robert Koenigsberger of Gramercy Funds Management on a market defying uncertainty. We begin this hour with equity markets shaking off a ton of policy volatility. Morgan Stanley's Mike Wilson writing import cost exposure for S&P 500 industries is more limited thus far, given the combination of the countries in scope and the exemptions seemingly still in place. Mike joins us now for more. Mike, good morning.
Good morning, John.
Have we actually been tested? That's the question I've got for you, based on the note you put out over the weekend.
Well, yeah, I think we keep getting tested back and forth, and I think Anne-Marie did a brilliant job of kind of describing yesterday as just another example of the president controlling the narrative back and forth. You know, maybe the timelines now, I mean, he lets things go even shorter and then he comes back and reverses. And I totally agree. I think it's about trial balloons. It's no different than Fed policymakers. It's no different than other policymakers coming in and they trial balloon it to see how it will impact the market. So have we been tested? Yeah, we've been tested severely in the first 3 or 4 months of the year. We had a bear market. Stocks were down 35–40% over the prior year. So, I mean, we had a bear market. And so people now are looking for I go, well, you missed the bear market. We had it. You know, we bottomed in April. And all the indicators we look at from a rate of change standpoint have inflected sharply. That's what we wrote about in our mid-year update. And it's even surprised us to the upside. I mean, the earnings revision breadth is explosive. And so you just can't deny that. You can't deny the fact that companies are good at mitigating tariffs, for example. Import prices really aren't up that much. So the question is, who's eating these tariffs? That's the big question I hear now from clients. Like, well, we're collecting all these tariffs, but where are they? Some of them are on the balance sheets of companies. It hasn't flowed through the cost of goods sold yet. Some of them are from exporters. They've discounted their pricing. They're eating the tariffs. And then some of it's going to get passed on to the consumer. That's to be determined still. And so as we've been saying, the third quarter is probably the quarter of risk where you'll see some of this flow through to the cost of goods sold. I don't think this is a massive correction. It's a 5–7% correction. For some companies, it could be bigger. But this is the quarter of risk for where the tariffs will start to hit. But the market's already thinking about this as a temporary impact. And 26 now on an earnings growth standpoint is looking better.
Is that a correction you'd be looking to buy then?
Absolutely. We're looking to, I'm hoping we get a pullback to some degree. I think a lot of clients are looking for a pullback of some kind. They've been surprised we haven't gotten one. But this is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, right? The rate of change is accelerating beyond what you expected. So it's just, I think the pullbacks will be short and shallow. Maybe there'll be another surprise, another test of some kind that will cause something more severe. But I really can't see more than a 5 or 10% correction given what I see now in the landscape.
When you think of tariffs, though, I think you're talking about the vis-a-vis country tariffs, right? The reciprocal. What about the sectoral tariffs? Does that make it more complicated?
Absolutely. I mean, and that's one of the reasons why I think a lot of investors have thrown up their hands and the market is kind of looking past this because there's so many carve-outs. I mean, even the USMCA, right? The exclusions, and that's what we wrote about this weekend. So a lot of the tariffs on China go, they go through backdoor through Mexico. Well, a lot of that's been excluded. So the 25% tariff doesn't even end up hitting that. Then we have the 232 exclusions. We just saw that now, they can sell semiconductors into China again. So, there's these carve-outs, and it's very confusing. My base case view, and has been this all year, is ultimately, I think that what they're going for is a 10% import tax, basically a consumption tax. And that's where we're going to land writ large. Now, we're not quite there right now. If you do the math, it's like 16, 17%. But ultimately, if we get to a 10% import tax, companies can deal with that. You raise $300 to $400 billion of revenue per year. I mean, it's not a bad strategy.
Does the one big beautiful bill tax cuts offset that import tax?
Well, that's exactly the strategy, which is that you're, instead of taxing companies and private companies and individuals, you're sharing the tax now through exporters, importers, and consumers, and then let the market figure that out. Like, figure out where the tax can get allocated. So what we're moving from is an economy where capital has been allocated by government to an economy where capital is being allocated by private corporations. That's the beauty of the big beautiful bill, is that you're basically shifting the economy mix from a publicly driven economy to a privately driven economy. Something we talked about 6 to 8 months ago, right?
But is there a fiscal impulse given the fact that really the crux of the one big beautiful bill is an extension of current policy?
That's right. So there's no incremental fiscal in the traditional way you think about it. However, there's a massive positive impact to cash earnings for corporations and an incentive structure to start investing. Something that companies have not been doing for the last 3 or 4 years is investing in CapEx. The bill basically encourages them to spend money on capital goods and R&D, something that we need to do to grow, down the road.
Let's build on some of this. You talked about the broad-based earnings revisions. Is that more than just AI, more than just big tech? Where else are you seeing that?
So it's been led by the Mag 7, so to speak, but no, it's actually fairly broad. Now, it is a larger company-driven sort of revision factor. So the small companies still aren't seeing it yet. That's why we've been underweight. We've remained underweight the smaller businesses. Now, that could change if the Fed starts cutting rates. That's something we're thinking about for 2026. But it is a fairly broad expansion. It's financials, it's industrials, it's some of the software stack, which was kind of left behind over the last year and a half. So it is broadening out. And this is, I think, a function of, look, there is pent-up demand in the economy. There is pent-up CapEx in the economy. And some of these incentives now, some of these tax changes, I think, do give clarity to companies now saying, okay, we can move forward with our business. The legislative agenda is done now. We can look forward for at least 3 years, maybe not beyond that, but at least for the next 3 years, and we got to get on with our life.
What are the kind of companies you like at the moment?
Industrials and financials really are the two areas we've been really focused on, and software, because I think a lot of folks are too bearish on software. I understand why. I mean, AI, coding and all that. But at the end of the day, this is the part of the tech cycle where you've done the compute, and now the application layer has to get built so that dummies like me on tech can actually use this technology and become more productive.
When I'm walking past the Hudson, down the Hudson in downtown New York, and I look across the river to back office city, compliance, all of those workers that are working for these major financial institutions, and forgive me because many of them are watching right now and this might be a rather brutal conversation, how close are we to seeing some big cuts to the amount of people that work at these institutions?
Well, I mean, compliance is definitely one area that will be hit not only from AI, but also from just a change in regulatory environment, potentially. We don't really know. I mean, we're not seeing it yet. Okay, I mean, I would say that the AI concern about employment, I think, is real. We're seeing it. Here's the lead indicator. So the largest companies who are very facile with data, okay, your NVIDIAs, your Metas, et cetera, are showing the ability to use this data. Microsoft, right, they're laying off people more and more because they're able to use this data. So the question is, can that translate into the average company in the economy? To be determined. But I think that, I don't want to make a statement here, that's not great for employees necessarily, but man, if you think about what that does for S&P earnings,
well, this is it, Mike.
Really, really positive. That's why the multiple keeps expanding, because that's what it's looking forward to.
The conversation for further down the road, and this is the next several years, you can have this really strange dynamic where the labor market data stinks, but the earnings coming out of these companies might be really powerful. I just wonder how far you can push that. How far can we push that?
Well, we're going to find out, I think, because I think U.S. companies are really good at cutting costs, whether it's employees or, other types of expenses. And so, I mean, that's what they're going to do, because we're still in kind of a slow growth top line environment. So companies have to become more efficient. Plus, they have to offset some of these other things like tariffs and things like that. So, but companies will figure that out. That's why the market continues to go for the high quality businesses. One other thing that we haven't talked about yet is last week's Supreme Court ruling, I think, was really fascinating with respect to the government's ability to do these, reductions in force, for the DOGE. And this could be also quite interesting development, where this is like the return of DOGE. Because I would say most people are disappointed that DOGE wasn't allowed to kind of complete the deal. They were kind of blocked. They weren't able to kind of reduce government headcount. And maybe this ruling by the Supreme Court allows DOGE to kind of return, and we could see headcount reduction in government, which is another type of a slowdown in labor, which won't affect the market, right? That's not great for government employees necessarily, but that will liberate, okay, kind of the private economy once again.
Two parts of these conversations, when you talk about the fact that more capital being allocated to the private sector, not the U.S. government. But if you have companies laying off people because of AI, who has to step in to help what potentially could be high unemployment rates? It's going to be the U.S. government.
Yeah, well, I would hope that, instead of laying people off, you just make them more productive. I mean, ultimately...
That's what everyone says.
Yeah, but I mean, look, at the end of the day, if you look at the private economy for the last 3 years, this is something that doesn't get a lot of airtime. The private labor force has not really grown for the most part, okay? It's been a government-heavy, healthcare-heavy, education, like state and local jobs. And so the private economy has been operating with fewer employees already. This is not a new deal. I mean, companies are, once again, really good at being more efficient. So my hope would be that we could just grow with fewer people. By the way, you have less immigrants now, right, because of the shutdown of the border. So we kind of need this. We need to fill that gap of making the people who are in America more productive, and so we can grow the economy.
Mike Wilson, smart as always. Good to see you. Thank you, sir. Mike Wilson there of Morgan Stanley. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump is softening his stance on China. Sources telling us here at Bloomberg that the shift is part of an effort to secure a summit with China's Xi Jinping and a trade deal between the two countries. The president's softer tone is reportedly causing tension, though, among some of his advisors who prefer a tougher stance against Beijing. Elsewhere, Walmart is cutting hundreds of store support roles. The cuts represent an ongoing effort by the country's biggest employer to make its large workforce more efficient. Earlier this year, Walmart cut corporate jobs and asked some workers to relocate to its headquarters in Arkansas and California. And United Airlines shares falling in the pre-market after the company reported second quarter results that beat analyst estimates but cut its full-year profit forecast. United CEO Scott Kirby sounding optimistic, saying that the world is less uncertain today than it was during the first 6 months of the year. Coming up at 8:45 a.m. Eastern, Lisa Abramovitz will be sitting down with Scott Kirby himself, and that's your Bloomberg Brief. John.
Lizzie, thank you. Looking forward to that later on in the programme. Up next, pressure building on Fed Chair Jay Powell.
Have you drafted a letter?
No, I haven't drafted a letter.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should.
Up next, the former St. Louis Fed President Jim Bullard.
Going to be the consequence for U.S. markets. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
For all the tantrums, the drama, the headlines, the S&P 500 so far this week positive by 0.06%. This morning unchanged again on the S&P, on the Nasdaq likewise. Under surveillance this morning, pressure building on Fed Chair Jay Powell.
There's lots of reports coming into this meeting that you planned on firing Fed Chair Jay Powell.
Those are reports, but they're not true.
Have you drafted a letter?
I haven't drafted a letter.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of firing. Almost every one of them said I should.
It's the latest this morning. President Donald Trump saying he's not planning on firing the Fed chair after reportedly discussing the idea in a meeting with congressional Republicans. The president adding he doesn't rule out anything. Joining us now is Bloomberg's Mike Shepard. Mike, are we seeing any congressional pushback at all to these threats?
Well, not on the Republican side for the most part. There have been a handful of lawmakers, including Republican Senator Kennedy from Louisiana, who expressed concern about the potential market impact. But overall, we're hearing from a number of congressional leaders, including House Speaker Mike Johnson and House Ways and Means Committee Chair Jason Smith, who spoke with Kayleigh Lyons and me yesterday in this studio on the whole Fed question, and they endorsed the idea of this pressure on Powell and even urged him to perhaps consider leaving the job early. Now, all of this does raise the other question of what it means for Fed independence. We've seen a number of critics say that, look, this amounts to an assault on the central bank that traditionally and by law is independent and not subject to the political whims and desires of the president or Congress necessarily. The president was also floating, as Anne-Marie heard in the Oval Office yesterday, a possible theory of the case for how he might move against Powell if he decided to do so. And that would be this claim that cost overruns on the Fed headquarters building in Washington are enough to merit closer scrutiny of the Fed chair.
Mike Shepard with the latest down in D.C. Shep, thank you, sir. We've seen the reports. We've heard the denials. Let's get into it with the former St. Louis Fed President Jim Bullard. Jim, welcome back to this program, sir. I want to get to monetary policy and economics before we get to the politics of it all. Do you think there is a credible argument for lower interest rates at this month's meeting?
I do think that the Fed could resume its normalization process, which was interrupted in the first 6 months of this year. So I do think that that is the baseline plan at this point. September would be a natural focal point for that, and then maybe follow that up at a subsequent meeting. But I don't think that the committee is considering sort of wholesale reductions in the policy rate because inflation is still somewhat above the target, and they want to see the effects of tariffs.
Beneath the headline, Jim, as you know, in the details, it's very much good versus services at the moment. How concerned are you by what's developing in services?
I still think that the overall inflation rate is going to continue to either stay where it is or decline slightly. And I think that's pretty good policy. I think you want to bring the inflation rate back to 2%, but not too fast. And I think they've got about the right policy to do that. But they do have some room to lower the policy rate. And I think you'll see that in the second half of the year.
Jim, you've been on the committee. You've got plenty of experience also of the pressure coming from the White House at the same time. The pressure coming from the White House in the president's second term is much higher, much more powerful, stronger than we saw in the first term. When you're on the committee and you hear these kind of threats, does it change the way you go about your business in any way, shape, or form?
No, it doesn't, except that what's happening is that this will induce inflation risk premium in the 10-year. And so you'll get higher 10-year yields than you would otherwise have if this wasn't going on. And then the committee has to take that into account. I don't know why you want to whip up an inflation risk premium, but obviously investors want to be careful. How much inflation is the new administration willing to tolerate going forward? And that's the thing that bond investors have to price in. So unfortunately, this is going in the wrong direction. That's also going to push up financing costs for the government. That depends on the weighted average maturity of the Treasury debt, and some of that's longer term. So some of that is going to be influenced also by the inflation risk premium that'll now start to develop. So unfortunately, this is going a little bit in the wrong direction, I think, from probably where the administration really wants to go.
That's the market impact. When it comes to the political theater of this all, JP Morgan's equity derivatives team is out with a note saying what's currently unfolding before our eyes has been happening for decades behind closed doors. Is this idea of Fed independence a myth?
You know, we've talked about it before, but I don't use the phrase, or try not to use the phrase Fed independence. I would say it's designed to be arm's length from politics, which would mean that the Fed chair is not a cabinet position like the Treasury Secretary that you get to appoint as soon as you take office. But you do get to appoint the Fed chair about 1 year into a new term, and you know, that's to give a little bit of political insulation, and so that things aren't moving, you know, quite so rapidly and are smoothed out a little bit. Otherwise, you would have a lot of back and forth as administrations come and go with monetary policy, and that would be probably counterproductive. Again, you'd get a lot of uncertainty in markets that would have to be priced in. You get a higher level of rates that would be unnecessary. So I think arm's length from politics is the way to think about this. I mean, you do have political appointees at the Fed, so obviously there's a political element to it, but it's designed to smooth out the ups and downs compared to what you would get for a cabinet level position.
Jim, as you know, each leader at the Federal Reserve has a different style. There is a theory on Wall Street, which I'm sure you've heard, that if someone is nominated by this president that the rest of the committee believes is just a political puppet, the rest of the committee will gang up against them, and maybe there'll just be a chairman in name only. Can you describe the dynamic on the FOMC, whether that's conceivable from your point of view?
Yeah, you did have the example of G. William Miller during the Carter administration, and he did not have the support of the committee or Paul Volcker in particular, who is then the head of the New York Fed. The story that I remember that your viewers might appreciate is that there was no smoking in the room. There was a no smoking sign, and Volcker lit up his cigar and started smoking a cigar. So I think that shows you what can happen if you nominate somebody and have somebody come into the job that doesn't have the respect of the institution. And by law, this is all done by committee, and really a chair has to navigate the committee and win friends and influence people. So that's a key element of the Fed chair's role.
Jim, I've only got 30 seconds left, so forgive me. But Governor Waller, what's your director of research at the St. Louis Fed? What kind of Fed chair would he make?
I think he'd be very good. I think he's a very strong candidate. I don't know if he'll win this, but he's certainly got a lot of background in macroeconomics and monetary economics, but he's also been on the board for quite a while now and has a lot of sense of the Washington interface. So I think he'd probably be a good choice here.
Jim, appreciate your time, sir. As always, the former St. Louis Fed President Jim Bullard on the economics of the moment and the politics as well for this Federal Reserve. Up next, Robert Koenigsberger of Gramercy Funds Management on a market defying uncertainty. Plus, Yahira with your morning movers at a rebound in aviation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's the story that just won't go away. The President of the United States flirting with the idea of firing the Fed chair, Jay Powell, denying it just yesterday. Jordan Rochester of Mizzou writing this: the denial has stopped the pace of the market move, but folks now need to consider the possibility in the months ahead. And this is the problem. The St. Louis Fed President, Jim Bullard, just moments ago on this program, basically telling us that this political pressure is going to make it harder for this Federal Reserve to cut. That's the issue. Equity futures right now in the S&P just about unchanged, on the Nasdaq 100 positive by 0.07%. We're 2 hours away from the cash open with your morning movers. Here's Yahira. Hey, Yahira.
Hi, John. It's a busy earnings morning, and the latest to report is GE Aerospace. Shares are up nearly 0.9% after it boosted its full-year guidance. That's because after a rocky start to the year amid all the tariff chaos, it is now seeing a surge in demand for its engines. Commercial revenue jumped 30% last quarter, and in that same quarter, earnings also came in above estimates as GE says that it's navigating tariffs by raising prices and keeping a tight lid on costs. Next up, we have Sarepta. This company has been in the news ever since its key gene therapy was linked to 2 deaths, but it is soaring this morning, up 31% on news that it will deliver big cost cuts by slashing its workforce, and news that gene therapy, which is its most important drug, will stay on the market, but with a new warning label. And we end on the rare earths mining company, and that is MP Materials. Shares are down 5% after it announced a $500 million stock sale, a diluting event that is weighing on the stock after some really big wins. Just yesterday, it said it clinched a major supply deal with Apple, and last week, a multi-billion-dollar deal with the Pentagon. So make no mistake, it is in hot demand, and shares are up 270% year to date. John.
What a move. Yahira, thank you. And I raised out this morning our top story: President Donald Trump denying he's planning to fire Fed Chair Jay Powell. Multiple reports surfacing yesterday that Trump was floating the idea and discussing it with Republican lawmakers.
So he discussed it with Republican lawmakers. I asked him this question about this draft letter. He said he discussed the concept of it with Republican lawmakers, and they were actually for it, but he's more conservative, he says, than they are. I think Charles Myers of Signum Global Advisors put it really well this morning. By issuing trial balloons like today's, the president is likely not just testing the market reaction, but also, more importantly, attempting to socialize the idea of Powell's dismissal such that it may be more easily digestible if and when it does materialize, potentially preparing the market and the public if he decides to pull the trigger.
Thank goodness we have someone like Scott Besson in the Treasury, because I'm sure Secretary Besson would be the first to point out, and I'm guessing here, but I imagine he'd look at yesterday's moves and look at yesterday's moves and say that is a market that doesn't take this threat seriously. Because if they went through with this, yesterday's price action, I've heard so many ridiculous words around yesterday's price action. Equities plunged, bond yields surged. Yesterday's price action was nothing. That was tame compared to what this would look like if you go through with it?
A blip to potentially what it could look like if he was to actually fire Powell. The other thing is potentially the market's also thinking about legally what is the justification for this. The Supreme Court has made it clear that the Federal Reserve is independent and even quasi of its own private entity. So this would get held up in courts. What is interesting is market participants sees this, and a few of them were calling me yesterday when all these reports were going on saying, I know you're at the White House, what the heck is going on? They're saying, why would he do this? Because he's going to get the outcome in the markets that is actually directly different than what he wants to see, especially when it comes to long-term rates.
It's going to make it harder to reduce interest rates. That's the issue we heard from Jim Bullard just moments ago, especially when this Fed is on a glide path towards cutting basically in September anyway. Why disrupt it over a few months? The pressure's going to keep on building, though, and maybe later on this month, you might actually get someone on the committee sticking their hand up and saying, you know what, we should cut rates right now and offer a real economic argument for that. Governor Waller, we're looking at you. President Donald Trump saying he will send letters to over 150 countries telling them their tariff rates could be 10 or 15%. Trump ramping up trade and tariff demands ahead of levies that are expected to go into effect on the 1st of August.
So this is basically deja vu from the campaign trail, 10 to 15%. A ring around the United States when it comes to tariffs. What's more interesting for me is what is happening in terms of the negotiations this administration is actively having with trading partners like the European Union. The top trade negotiator is in Washington having conversations with Howard Lutnick, the Commerce Secretary, and USTR Ambassador Jamieson Greer. With Japan, Scott Bessent told us, the Treasury Secretary, he's there for at World Expo Day. I beg to differ that he is not going to take some trade meetings on the sidelines. And then, of course, what is happening with the likes of Canada, Mexico, Switzerland, South Korea, these big trading partners, this is where it is going to be interesting and what kind of rates we settle on.
When you asked Secretary Bessent about this earlier on this week, about deadlines, he really played down the deadline for China in the middle of August. How seriously should we take the deadline for the start of August for everybody else?
Well, the start of August feels like potentially we're just going to get these letters, but for those big trading partners, if they are in active negotiations, good faith we've heard from this administration. I have heard from their Swiss counterpart that they have been told and given assurances that they will get an extension if the talks are still continuing, then August 1st will come and go. But I think for those 150, maybe the president will just set a basic 10, 15%, and those letters will go out.
We've got some additional news this morning. This from the president also posting on Truth Social that Coca-Cola has agreed to use cane sugar in Coke beverages in the United States. Coca-Cola responding with this quote, "We appreciate President Trump's enthusiasm. More details on new innovative offerings will be shared soon."
So I know what you make of this. One, we do see this MAHA movement moving forward. We saw that earlier in the week when it comes to these ice creams saying they're going to get rid of like the red 40s and some of these dyes that are in their products. The president is touting that they're moving to cane sugar when it comes to Coke. Now, he is a big proponent of Diet Coke. So this really won't matter for him because they use artificial sweeteners. But then Coca-Cola comes out with this statement and saying we like the enthusiasm and maybe we'll have something to share. It doesn't sound like this deal is done just yet.
I don't know if it's done or not. I will tell you this. This will help sales. At Casaferro, we don't drink Coca-Cola, but if they go back to cane sugar, that will be in the fridge. They'll be in the fridge just to try it. I won't be alone. Others will follow. A lot of people will do the same thing because they'll want to try the difference. Everyone goes crazy about Mexican Coca-Cola in this country, right? This will help sales in the United States. Whether it helps margins, I've got no idea about what it means for costs, and the company can share that further down the road, but for sure it will help sales.
The Trump effect. We'll have to see their sales figures when this potentially comes out, hits the markets, and whether some people want to try it. I think I agree with you. I don't drink soda. Once in a while, if I'm really on low levels of sleep, I will have a Diet Coke like the president. But if they have a new offering in this cane sugar the president is enthusiastic about, I think I'd try it.
For sure it will help sales at my house. I don't know about the rest of you, but I imagine it will. The stock is up in the pre-market by 0.25%. Let's turn back to the broader market. Robert Koenigsberger of Gramercy writing the following: the start of the third quarter brings a familiar level of uncertainty surrounding the US and tariff policy, yet financial markets appear far less jittery than at the start of the previous quarter. Robert joins us now for more. Robert, welcome to the program, sir. Really want to lean on your experience in emerging markets. If you look at what's been developing over the last year or so, the chaos is in DM, is not in EM. And I just wonder from your standpoint what you make of the role reversal of 2025 so far.
Sure. I mean, this is a phenomenon that, quite frankly, we're used to in emerging markets. You know, if you go back to the 70s and 80s, it was like the developed markets got sick and emerging markets went to the hospital, so to speak. So, you know, I spent the better part of 25, 35, 40 years kind of dealing with endogenous risk within emerging markets. Now, once again, we get to think about exogenous risk coming from outside of emerging markets.
Within DM, we're starting to see these EM dynamics really take hold across asset classes, Robert. To your point, we're seeing cross-asset correlations break down. Stocks, bonds, the dollar all move in the wrong direction in series of, at times, of stress. And I just wonder the lesson that you've got that maybe you could share with some people in DM from emerging markets, your experience of that, and ultimately how to navigate moments of stress when everything moves in the same direction.
Sure. I mean, the only thing that's certain is uncertainty. The only high conviction you should have is low conviction out here, and one has to think about and prepare for that. And, you know, one of the things we also wrote about this quarter is, you know, kind of embracing the volatility. We should expect volatility. That's the highest conviction theme that's out there right now. And if you embrace volatility, that means plan the trade and trade the plan. I know it sounds simple, but, you know, buy when the market's down and sell when it's up.
We've seen a ton of that. It sounds simple, and it's worked. Because we had a massive U-turn, massive bounce in the equity